Well, good morning, folks. Just an audio check real quick. All right, latency test now. It's about 3 seconds. Not bad, not bad. Hope you're all doing well. Give everybody a minute or two here. Just want to get a couple thousand watching before I start talking. There you go. All right, again, good morning. Happy Monday to you. So we are looking at the NASDAQ here. And I'm sure some of you are wondering, what on earth is ICT hiding? Look in the upper left. You see that right there? Some of you have actually been leaving comments saying, all right, dude, what indicator you're hiding? um, I have students all around the world that will tip me off on some things about some tools or little things that TradingView, in other words, they see me doing something, maybe on a live stream or something in a recording, and they'll say, hey, look at this ICT. I think this will be helpful. For the most part, most of the things that they tell me, either I know about because another student has taught me about TradingView's little hot buttons or shortcuts or whatnot, which I'm thankful for. I'm not so old and set in my ways that I won't learn something from someone, even a student, if it's useful. Not in trading, but in technical stuff like TradingView. But the little thing here is just the watermarks. It's not clear to you. Not that this is a plug for any one of these individuals. I'm testing them to see if they accomplish what I want. And honestly, this is not big enough for me. I'd like to be a little bit more obnoxious and larger than that. And this is just me. What I usually do, I just add something and move it around because there's dipshits on other platforms, and they take my content and they act like they're me, and they're not. So, as a reminder, I'm not on Instagram. I'm not on Discord. I'm not on Facebook. I'm not teaching paid mentorships. So if people are soliciting to you, directly or indirectly, asking you for money, that's not me. I'm not here doing it for free. So anyway, I got a lot of questions over the weekend for students that have been with me for a while, and they wanted to know how someone with more experience would use what I'm outlining for Caleb's model in their hands. So I kind of demonstrated that this morning. I also kind of like to segue into entering entry patterns and how to enter into the setups that we're looking for. Also, how to get over that hump of fear of being wrong, because before you start trading with a demo account, you're going to be watching price action. So we're going to do a little bit of a time leap just for the sake of answering questions and also give the direction to my son Caleb where he's going to be going to next after spending some time doing what we're doing. He's not there yet, so don't think for a second he understands how to determine the draw on liquidity. That's the part he's working on. So, which is what every one of you are probably doing too. And there's nothing wrong with that. If it's taking you a little bit longer than you thought it was going to, just relax. It's fun. But the mechanics of how we look at price action, the framework I'm going to start teaching on this week, and we'll be doing some afternoon sessions as well this week too. But the Jackson Hole Symposium and Fed Chair Powell is going to be jawboning several times this week. We have a speaker that's been talking, I think, for about 11 minutes, 12 minutes now, or was scheduled to. I don't care so much about that. And when Powell talks, I am aware. I'm trying to either be out of the way before he starts talking and wait till something happens in the price action that makes sense based on the time he's talking. They'll say it's because of what he said, and it's not. It's the actual intervention that's being influenced over price action. It's not the buying and selling pressure. It's they will do certain things in price action and use the excuse that it was POW, but it's really just them manually intervening, and that's just the way it is. But Jackson Hole Symposium is typically an opportunity for some wild stuff to occur, and we'll probably see some really nice volatility on Wednesday, Thursday, and Friday as a result of all that. So anyway, we are looking at the new week opening gap for this given week, and I have to take you back to the 1 minute chart. This is how you calibrate your levels. Okay, so here is the settlement price on Friday. The last tick is the close, so we want to annotate that. So that's 19,604. Young man in the comment section asked me why my new week opening gap isn't lower. And then here is the opening price Sunday at 6 p.m. and that's the new week opening gap. There is no consequent encroachment being annotated there because it just fell short of 20 handles. And you're welcome to do that if you want. You simply just take the fib, drop it on the low and the high, and there's your consequent encroachment. You can just simply just take a horizontal ray, drop it on there like that, annotate to whatever color you want, and call it the date. New week opening gap high August. I'm sorry, not high, but new week opening gap August 18, 2024, and then C period E period. And that'd be it. But I don't need that. But you're welcome to have that on your chart. That's nothing wrong with it. And again, that's what this little thing is up here for people sign on late. I'm not hiding indicators. I'm hiding the watermarks. So again, these are not me co-signing or saying they're good, that I love them. This is not big enough for me. So I'll wear an extra large. So petite like that doesn't work for me. Okay, so we are seeing the responses off of that really opening gap here. We trade down to the low. We have really nice relative equal highs in place now going into the opening. At 10 seconds, 12 seconds in post opening bell, we've attacked the relative equal lows here. And I'll go over this trade that I did this morning to show the students that are a little bit more advanced how they'll use the entry models that I'm going to be teaching using Caleb's model. All right, so let's take a quick look at the regular trading hours. Never be in a rush. Don't feel like you're missing anything. And we'll take this off for a sec because it's in the way. So we have this price here. That is your opening range gap high. We are now trading and formulating the opening range. Okay, so the gap is the difference between where we settled at regular trading session hours and where we opened. So that is this. This is your opening range gap. Okay, you can create it out. Let's go back on that. All right, so that's your range gap. We came back up almost 3/4 of the way, if not actually 3/4. Just fell short of that there. See that right there? So I'm measuring the opening price to where we closed previous session on regular trading hours. We have relative equal highs, and we didn't quite completely close that in. It's the first few minutes of trading. So I'm watching to see if we have any interest in doing that. Holding no hard bias right now. We have a little bit of sell side resting below these relative equal lows here. I'll dig in, see that swing, it's a swing low. So don't look at this area here as, you know, there's no low there to mark with this one. It is this one and this one. So you use the lowest one. You're gonna take that. And don't want it red. Okay. So we just came back up, hit the new week opening gap low here. And you can see there was a response off the lower quadrant on the opening range gap, which is shaded here in pink. We just banged the bottom of the opening range gap low again. And the buy side is here. Sell side is down here. If you want to overshoot that, how far can it go below here? You can touch the new day opening gap on August 16th. So that's the benefit of having these levels on a notepad or on your chart visually. This is a little too busy for me. I'm going to take that off because it's distracting to me. But if it helps you, by all means, keep it on your chart. These are the lows where sell side is. So I'll annotate that. You should be doing this on your chart, not worrying about where I think it's going to go next so you can try to trade. If you're doing that while you're watching my live streams, you're not learning. You're copycatting, and you're copycatting with limited understanding. You have no idea what I'm talking about and why I'm even referring to it. So that means you're going to be in a high anxiety state of mind, hoping that something magical happens because you followed your impulsive nature instead of wanting to learn how to do this stuff for real without looking at my videos ever again. All right, so that's your range for liquidity on both extremes. You have buy side and sell side. So far, we have respected the opening range, failed to get at the 3/4 or upper quadrant level, consequent correction of it. And do we want to sweep down to engage this liquidity here, and retap into that new day opening gap on the 16th? And then should it do that, I would expect it to try to make some kind of an attempt technically, not to run right straight from there, but to give some kind of technical indication that it may want to be interested in going up here. So that means I'm kind of forecasting some idea technically that would potentially form, say, a very small short-term breaker, a shift in market structure, some kind of a fair value gap to come back in, tap into. And if it gives that type of intel, if it gives that kind of technical formation after trading down into here, then I'd be interested in see, does it start building all of those same things that we look for in all the price run from here all the way up, using every reference point there carried over here? Does it use it like a footing to climb higher to make an attempt to get up in here? I'm not calling that as a bias. That's something I'm interested in to see if it'll do it. That's not me saying I'm only waiting to do that, because right now I'm waiting to see, does it want to trade down here? Now, when I say things like that, I see comments in my own videos. In my live stream doesn't have an ability to leave a comment, but usually they'll go to the most recent post on the community tab or the most recent video where comments can be left. And they'll say, he doesn't know what I'm referring to me. He doesn't know where it's going. He doesn't know how to trade, something to that effect. And you really don't know what I'm doing because you don't listen. Just like the individuals that are telling me this trade shouldn't have been taken because you're supposed to be waiting for relative equal highs and relative equal lows. And again, you don't know what I'm addressing. You have no idea what I'm talking about and why I'm talking about, and the audience members. So there's the reach below the sell side liquidity. So what you want to do is for that, you want to screenshot it and go into your 15-second and 30-second chart inside of the opening range gap. We'll do that. How far can it trade below the sell side liquidity? Initially, it can touch the new day opening gap here, as we just saw here. You want to screenshot that on your chart, not my live stream. Don't do that, because if you do that, you're not doing what you're supposed to be doing. You're supposed to be doing this with your own charts. So a price run from the new week opening gap low or say the lower quadrant or the consequent encroachment, that would be a nice run to go back and do a back study on, taking screenshots of it, looking for reasons why it would be a pass, like I wouldn't take that trade, even though it delivered, or this is what my entry model looks like. Because in the beginning, you're gonna have to try to capture and collect a lot of this type of information to kind of like to promote the idea of inspiration and keep you motivated, because you're not watching a demo ticker go up and down with profit and loss. So it makes it very boring. And that's okay. Boring is good while you're learning. Because eventually, if you do everything right, this stuff can make you profit. And that profit is only determined and limited by what you have put into it. So I want to show you inside of this opening range gap what makes it the opening range gap. We have 930 here. That's the opening price. That's what's being anchored to. And the high is where we stop trading regular trading hours. So real quick, let me pop it up here. That's this on Friday. So regular session trading settlement is 4:15 p.m. Eastern time. Even though electronic trading continues until 5 p.m., then it stops. And then because it's Friday, it doesn't resume until 6 p.m. Sunday Eastern time. On any other day but Friday and or a holiday, we have that 5 p.m. stop, and then it resumes 1 hour later at 6 p.m. So it's very important you understand what these levels and what I'm referring to. This is the opening range gap, the difference between where we settle at 4:15 p.m. Eastern time and where we start trading regular trading hours. Not electronic, regular trading hours. That means we start trading at 9:30 opening bell Eastern time, just starts ticking. We round up. Now we overshot the new day opening gap, so we want to see, does it want to make an attempt to get in here, find some footing inside of these wicks? Why? Because there's consequent encroachment in that. And then maybe wick out of that, come back down and tap the new day opening gap high again and start making some structure to maybe return back into the new week opening gap low and get back in potentially into this opening range gap. I'm not calling that. I'm looking for reasons to hunt a setup should that form. I've already outlined where it was going to reach to. You're looking for reasons to justify why the market may do a certain run here or there. What's nice is, or what is nice rather, is that we've already had the sell-off down into the liquidity we were looking for. And we have these relative equal highs that are just sitting there. Now, who's made money so far this morning? Shorts. So the initial opening range is 30 minutes long. It's not 15 minutes. I don't care who's telling you that. Okay. There is no 15-minute opening range. That is something that is just a gimmick for to look different, to stand apart. I promise you, it's the first 30 minutes. That means 9:30 to 10. So you're best served by not taking any entries in that first 30 minutes when your experience level is nil, zero, when you don't know what you're looking for, when you don't know how to trade, you don't know how to read price action. To sit still for the first 30 minutes. Number one, it teaches you discipline, it teaches you patience, and you're also going to filter out a lot of the fake price setups that you're probably going to be impulsively chasing. Oh, I got to chase it. It's doing this, it's doing that. He's wrong. He's live streaming. He said his bias is here. These are all the comments that I see in other people's YouTube channels, leaving comments about me, or they'll leave it in my comment section. And you don't know what you're talking about. What I'm teaching is how my son Caleb, who isn't good at reading price yet, he's not good at it. I don't know what part of this that you don't understand. So to give him a framework to start with, what should he start doing? What exercises should he and anyone else that wants to do the same thing he's willing to go through? How do you start? How do you start with ICT stuff? What videos should I watch? What should I? You start here. I'm literally talking to someone that's brand spanking new. Well, he's not brand spanking new, but in terms of being able to go through it with a structured approach, not just simply me telling my son, say, hey, go to my YouTube channel and go through the mentorship videos. It's a lot, and it's very intimidating. So what I do and how I taught people in the 90s was I would sit down with them and say, okay, here's what we're doing. We're watching price action. And I would point out things like this and tell you, look at this, note this, watch this, and see, does these things have a interest in your observation? Do you see something there that is obvious that would draw your attention to it? See how fast we came right back up in the opening range gap? ICT's wrong. So many other jokers out there doing gold buck and supply and demand. They're down here, they're trying to sell. And he's wrong, he ain't gonna go back up there, and we're in here now. But they're never gonna show you that trade. They're never gonna do that. So we're inside of the opening range gap. So now what we've done is we've gone just above this high here. So we've now delivered buy side a little bit more. Buy side still is inefficient until we touch the high of that. Now it can touch the new week opening gap low and wick just outside of it because we have a little bit of inefficiency. See that candle's high right there? And where we are here. So it can go back down into this portion. The wick can go below this new week opening gap and still maintain the structure that's conducive for it to go back up here and challenge that buy side liquidity. That everybody feels safe right now. Would you feel safe if your stop was there and you're short? Imagine that. Say you're short and you have a stop loss right here. If your stop on a short position is sitting right there and you didn't want to trail it, okay, because you didn't want to lock in anything, and you gave up all of this. If you give up 60% of an open profit of a trade that's unrealized, in other words, you haven't closed the trade yet because you're trying to hold for a long type move or whatever. 60% of retracement on a trade and you didn't take any partials, to me, is something I would not be comfortable with, because especially when you're first learning how to trade, or you're trying to find a model or develop a model or develop some kind of a skill set to lean on as this is what I'm trying to do. And I'm going to work with this until it proves that it's ineffective and or I find something better in the process of using it. Because that's what my hope is with my son Caleb, by forcing him to use the entry mechanism of the fair value gap within the context of order flow. Not the bullshit that's level 2 and depth of market and volume profile. Volume profile is a bunch of bullshit too. I might as well just toss that out there. I know I'm going to break some hearts. I don't give a fuck. Okay, because the little boys that are on other YouTube channels, leave your comment in mine. Leave your comment on mine, and I'll let it be seen, and then I'll challenge you openly to bring your Mickey Mouse shit on live. I'll stream right next to you, and I'll have a chart or a screen with your bullshit live, and I'll show you that you don't know shit. You don't know anything. But you won't do that. That's okay. But by looking at the fair value gap as an entry mechanism initially, it may help him see like the order block. It may help him see a breaker. It may show a inversion fair value gap that might be his model. But because he has the fear of it's too much information, Dad, it's overload, I don't know what to do, and he's my son, and it's something that most people do when they come to my channel. They're like, man, where do I start with all this stuff? Because you don't want to waste time. Well, there's no such thing as wasting time, because if you just start and start getting your hands in price action, start looking at what price is doing and how these things are annotated in price and how I call your attention to it, you will by default build a baseline understanding, and then that way you'll be able to grow from there, regardless of what you start with. If it's order block, if it's optimal trade entry, if it's whatever. The list is long, right? But whatever it is, as long as you start, that gives you the baseline to build on. But if you spend so much time, or just say, I don't know how to start with this guy, he's too many things, or I've read some negative stuff about him, okay, you're the person I don't want to talk to, because you didn't even bother to look and see if this stuff that's for free has any merit for you. So we came all the way back down into this area here with this wick in closing price. This area here should not close in now because we've already went back into the opening range gap. I'd like to see a close above the consequent encroachment of that, and then next candle come down, fail to touch consequent encroachment, and then springboard into upper quadrant of the new week opening gap high, and that mid level between halfway and here, which would be upper quadrant. and then build some momentum to try to get into that buy side. And then once should it do that, we'll drop down into the 15-second chart and we'll look at where we have traded from here, all of the turn in here, and all the business here. And I'll show you the way you would go back through, and also how to use the information I was shown as an actual live execution with the NQ earlier. Damn, ICT, you had to tell me about profile, volume profiles, bunch of shit. It is. You're looking at gimmicks, you're not looking at price. But you say you're looking at price. You're saying you're looking at order flow. No, you're not looking at order flow. You have no idea what you're doing. But it sounds technical. It looks cool with all that horizontal, vertical volume nodes and all little highest high and lowest low volume. It sounds real technical. And none of that shit matters. It literally has nothing to do with it. All right, so we were able to get to the high of the opening range gap. One more time, tapping in here. Look back where we are in this. No actual fair value gap. That small little separation right there. See that? That's the only thing that my eye jumps to. And that's about midpoint of that down close candle. So in my mind, can it touch that again? It could. I'd rather it didn't. It needs to get up into and use this little area in here as a footing. If not, run right on them and take the buy side out and break the hearts of those that are short because they're trying to fade me. Show me that video. Show me that one. I have so many people counseling me in the comment section too. You spend so much time on the people that hate you, and you don't spend that much time on the people that love you and support you. I'm spending more time for the people that love and support me by actually doing the content. That goes without saying. I'm just having fun with the people that think that I'm getting a broken heart over anything they say because it's nonsense. But it is humorous. You should be thankful because a lot of that stuff spurs my interest. I like coming out here and rubbing their nose in it. All right, so see the volume imbalance right here? Now, with what we already have in price, when we came down here, whipped below the new opening gap from August 16th, came back, climbed all the way back up into the opening range gap, which is shaded in pink, and found its way to the high end of it. We're inside of this little business here. This to me is a little porous because we had these two candles in here. Even though the opening of this candle and this close of this candle are essentially the same, this sputtering, this like little bit of pause without any bodies forming, kind of like, in my mind, thinks it has to deliver a couple times in that area again. And you can see we had it here. We had a buy side here. We opened, traded back down, and we opened, traded right one more time up. So we're getting that return back into the opening range. So that's what I'm saying. We have to get through this area here. I gotta get a cup every time I get a washroom. Every time I open the water to get a drink, the clicking and all that sound, that would get on my nerves if I was listening to someone else. So I'm trying to make myself mindful of that. I always say it. I just don't do it. It's just I grab a water and head to my location, and that's where I'm going to stream to. For your notes also, just know that the Jackson Hole Symposium, whenever that occurs in price action, you're going to get a lot of overlapping price delivery. That means a lot of back and forth. It's going to re-deliver over ranges that would otherwise, in any other given climate, it wouldn't generally do that so frequently and so often. but that's just the characteristic for this event that takes place. And what is the Jackson Hole Symposium? It's a bunch of jokers that come together, okay, and they look at trends, they look at things around the world, and it's it's a matter of people that I don't want to fraternize with, and I would never fraternize with. And they're like they think to themselves as they're the elites or whatever, and they look at how they can push things around. I guess put it that way. Now you might not hear it described that way, but that's really what it is. But because of that, there's people that are always sitting outside waiting for someone to drag to the side and say, "Hey, could you tell us what's going on? Like, what's the hot buttons this time? What are we listening for? What are the directions in all of this time?" And sometimes they're very closed lipped. Sometimes other people like tossing out hints, and news wires or people that are pumping that kind of information out. They will do that with the expectation and hopes that it will spur on market sentiment or disrupt market sentiment. Again, I could care less. Price is either going to tell me or I'm not doing anything with it. And that makes it a whole lot easier. It doesn't complicate things because as soon as you start asking for, what do you think's happening? What do you think's happening? Who gives a shit what they're thinking? The market's going to do what the market's going to do, and you have to be there to react on it or stand aside. So we're spending a little bit more time in the opening range than I would have liked. So if it's going to run for that buy side, it would need to giddy up and go and not do a close below the midpoint of that wick right here. Can it come down, tap that, and come all the way back up and run over top? Sure it can. But I wouldn't personally want to be interested in seeing anything on a close below the midpoint of that. I'd like to see this stay open. If it comes down and hits it and rejects, that's another entirely supporting thing that would be in the delivery, but still I wouldn't want to see it. In other words, say I was in a trade, I would not want to see it come back down in here. I'd like to see it support the wick here with no close below. Excuse me. Okay, you're in that wick. I'm sorry, you're in that fair value gap below the wick. At the end of the week, when you get to Friday, when it's no longer trading or the weekend, go back and look at your 1 minute charts and you'll see a lot of overlapping price delivery. Back and forth, back and forth. That's usually what you get on the week that Jackson Hole Symposium unfolds. It's just one of those things. I don't know why it does it, so don't ask me, okay? Because it's not like I'm hiding it from you. I just noted that that's something over the years that I tend to notice. So how could you use that information? You need to be, if you're going to be trading at all during the week of Jackson Hole, especially during the days like day 1, day 2, day 3 of this week, you want to be thinking about where your first line of partials are going to be. And don't think, well, I'm going to outsmart the market. And while that would be a wonderful place to take a partial, I'm going to be a little bit more greedier. I need to hold for a larger trade. I need to impress somebody else. And that's something you shouldn't be trying to do. You want to find a level that's easy, low threshold, and then get out and take some partial profits. Because if not, what will happen is you'll be in some really nice trades and you'll be riding a run from a low or to a high down to a inefficiency or something to the effect of a discount. And it'll feel wonderful while you're in it, and it could be delivering rather quickly, but then it'll completely overlap all that run again. And if you trailed your stop, you'll get knocked out with nothing, or you'll get stopped out because you're trying to hold on to something that isn't going to deliver in one-way delivery, like one-sidedness. It's going to be back and forth, and it's going to completely overlap a price run that you wouldn't generally expect it to do. There is no other time of the year or any kind of other event that I've noticed that it has that characteristic. It's just something that I've never seen anybody else refer to it or whatever, but it'll be something everybody talks about now. But I want you to look at it this weekend. Go back over your charts and you'll see there's a whole lot of overlapping of what price has done before it goes to significant targets or objectives. Yeah, I wish this thing, to the fella that made this one, I'm not sure which one it is. If it's this, yes, that one. So AGFX. I'm assuming that's the person or the account for TradingView, or that's their, I don't know, I guess that's what they call themselves. If you could make this bigger, because the large is, I have it set to huge, and it doesn't do it enough for me unless I'm doing something incorrect with it. So if I'm doing it incorrectly, um, send me a video with a short little private video uploaded to YouTube. If you send me something that's an MP3, or I'm sorry, MP4, and I'm never going to open that up because you might be sending me a virus, and I'm not trying to do all that business. But if you send me a YouTube link to a private video, I'll watch that. Don't make it a long one, please. I don't have time to be watching all that stuff. But if you can make it larger, and I mean like from here to here, so about that broad. That's what I want on the chart. If you go back and look at my other videos, where I actually type out the watermark itself as an overlay, I put that watermark as an overlay on the Camtasia recording. So it's technically not there when I'm recording. And then I overlay it and reduce the opaqueness. And that size is what I'm looking for. I haven't looked at every single one of the TradingView indicators that do a watermark. So just know that these are the only two I've messed around with. Not that anyone recommended either one of them. It's just, this is what I've used for right now. I wish I didn't have to even bother doing it, but people with less class and bottom feeders, they like to take people's content, especially mine, if I'm executing, if I'm highlighting something, and they can put it on their social media account that's pretending to be me, and it makes it look like it's really me, and it's really not. They just take something I've already produced. So see how we're back and forth? Everything's overlapping the previous short-term run. And if you're expecting, that real nice one-directional price runs during the week of Jackson Hole is going to frustrate you, because this is what I've encountered. Now, is it every single week that it does that when it's Jackson Hole? No. But predominantly, I have learned that trades will come back on me deeper and run right back over top of the short-term price legs. And if any other instances of me where I will roll the stop and cover costs, cover commissions, cover whatever, they generally will come back and hit that stop loss, because of this is the climate that it creates. So if you're going to trade, you want to be looking for, if you're in a long, as soon as it trades into a premium inefficiency, that means a sell side imbalance, buy side inefficiency, or a short-term high. If it clears the short-term high, you better take something off. And if you don't, you're literally asking for the market to take every opportunity for you to find profit away. Only during this given week, though. There's no other climate, there's no other thing that goes on in the economic calendar that I have that same observation with. So it's just a matter of everything redelivers back and forth, and it generally does it the week of Jackson Hole. So when can you expect seek and destroy? Jackson Hole. But it can be done in a manner where you don't see it coming. You don't really think it's there until it's actually stopped you out several times. And the worst thing you can do is overtrade on this week. So know what you're looking for. what's the easiest low-hanging fruit objective. Say, for instance, you felt strongly that this turn down here was something to be noteworthy, and we thought that the opening range gap could be a nice draw. Well, when we ran up into it here, you created that short-term high and didn't completely close into the top of it. When it trades back down, as soon as it crossed it right there, that would have been a partial. I was pulling your attention here. It needed to get through that. It went right up in that area, stagnated, and then rolled down 3/4 of the opening range gap, lower quadrant of the opening range gap, and failure to get to the new week opening gap low or touch the opening range gap and displacement to the downside. So watch this wick in here. This is the lowest one. Again, these are my fib settings so you can see it. So far, we cleared the rejection block, which is the lowest down close candle in the swing here. We swept that there. Do you feel safe if you were short up here? If you shorted in here with your stop loss right there, would you feel safe? What if you didn't sell short there, but then you sold short here? Would you feel safe with your stop loss right here? I probably shouldn't shuffle cards. You're going to hear that and think, what's he doing? Leave a comment, even though nobody else sees them, on my most recent community post. Leave a comment and tell me, do you fidget while you're watching price action and or trading? And if not, what are your hands doing? And don't be obscene. I touch myself, ICT. Some of you are going to use the opportunity. Of course I'm touching myself. I watch Deadpool too, right? That's not what I'm inviting you to do. You guys are creepy. Note that volume imbalance right there. See where the bodies are closed at? Right inside that volume imbalance. That's the stuff I like to look for. The wicks are allowed to do the damage. And that's the part when candles are open and they're still forming. They haven't settled and closed and started a new candle. That's the stuff in a book that can't be, like, you can't get that information shared with you watching, well, not watching, but reading a book with static charts. Even if I did a multiple series of updating of, like, think about how long the book would be if I was showing you a candlestick and screenshotting every fluctuation while the candlestick was still active, what it would look like and how it's morphing. Like that I just don't know how, I don't know how to communicate that outside of actually watching price action with you and observing and pointing and saying, look what it's doing here. And or look how it just did that when we were watching this candle. We were watching it reach for this. We were watching it reach for that. That's that's an organic study that you can't replicate that. And even market replay doesn't do it. It does not do it. So you have to have someone that's sitting with you live, pointing out certain things in price action that are salient to why things should or shouldn't behave. But you have to watch it and also relax and know that the wicks are going to reach outside of the levels that you want to see them stay within. And that's one of the things you're going to have to get comfortable with, Caleb, because when you're looking at price, the first time I showed him a fair value gap, he thought that, by me describing it, it should go right in there. Don't go outside the lines of the low and the high of it. Just go right into the middle, completely overlap it perfectly, and then move to the higher low that we were aiming for as a draw. And then as soon as it would go outside the line of the low, if we're trying to use it for a long, and as soon as it would color outside the lowest boundary of it, and the body of the candle is still active because it hasn't closed yet, but it's just outside of it. And he's like, okay, well, Dad, shouldn't we get out of this right now? Or is this not going to go up because look what it went outside? No, that's the part you have to submit to. Like, you have to watch these things. And when you see that it's just forming the wick, that's all it's doing. And before it can become a wick, it has to be a bold faced candle at the level that makes the low of the wick or the high of the wick. So you can't appreciate that unless you sit here and watch very low time frame charts, because you get lots of examples of it. Look at the reaction off that volume bounce I went into. And look how the body's closed right at it. See that? You're going to find that in Wyckoff? The fuck you are. It's not in there. It's not in there. So here at the opening range, gap, high again. So now we don't want to see the midpoint of that. So let's highlight that. We don't want to see that breached, because we've been here multiple times now. No close below. It can touch it. It's better if we don't go down and touch it at all. And okay, we touch it now. It needs to be responsive. We don't want to see it come back down below the new week opening gap low, which is this level here, on a closing basis. We don't want that. All of this, while the candle's open, completely normal. Nothing to be worried about. Nothing to be concerned about. It's exactly what you need to see. If a wick's going to form, you got to give the candlestick the opportunity to go down there or go up there to form the wick. If you try to be perfect and say that it can't do this and can't do that, it's going to humble you fast, and it's going to make you frustrated. It's going to make you feel like you're never going to be able to trust anything reading price action. See what this did? There's the wick formation. We opened, touched one more time the consequent encroachment of that opening range gap. Delivery, now it needs to speed up right above here. And for the folks that had their stop loss here, their hearts are broken. We're going to fade ICT. I'm recording. I can't wait to show it. This is what I did against ICT. Well, you're not doing that shit today, are you? Here is the buy stops that are resting above the relative equal highs. And as I'm pointing out things, okay, what you should be doing as a viewer and what Caleb should be doing is, when I mention something, okay, for instance, when I talked about how we could go down here and go into the new day opening gap on August 16th, it can trade down you can trade down into that below these lows over here. How far can it go? Well, if it's going below here, how far can it go? Into that new day opening gap that's old. It's an old one. It's stale, right? No, it doesn't get stale around here. But then you have this swing low here. So we have sell side that can tap into an old new day opening gap. But what did I teach you last week? What did I teach you about that? That we can see them, trade through them. And then you want to see how they behave once it does it. We're not always expecting a stop and turn, no further run through, nothing that's demanding precision like that. Entries, you can frame entries with precision elements, but we're looking for a bias. We're looking for some kind of like a sentiment to shift in the marketplace, but we have to allow the market to deliver to these inefficiencies again. And if it's going to go through them, which is a normal characteristic, especially if we're anticipating a early session start to determining a bias. Well, we wait for it to trade through it, and if it's going to go through that, what's to the left of this? Relative equal lows and their sell sign. So at that price level right there, we have 562. Market drops all the way down, clearing out all the way to 544.5. So it's allowing for any liquidity that would have been trailed from that low. They cleared that out. Took it all the way back up to opening range gap, failed in that little area I told you we needed to get through, broke lower, swept one more time, rejection block, didn't get the consequent encroachment of that wick. Notice that? We didn't get the consequent encroachment of the lesser wick either. See that? Oops. Every single time I do this, it jumps every time. It goes to just short of the, where's that, right at the quadrant? Let me see, what is that? Yeah, it hit it perfectly to the tick. So the quadrant on the initial wick hits it perfectly to the tick. I'm watching the low. So if you look up here, that price right here, that's what I'm looking at. Right on that candle, the low is 560.25, and the upper quadrant level is 560.25 for this wick. See that? That's just probably random. But the point is we didn't get to what level? It's midpoint. On either this wick or that one, it stopped, went right to the rejection block, which is why I was mentioning, so we just cleared the rejection block. Watch that wick. So your observation and your takeaway for this is you want to annotate how this low stopped directly at that wick's quadrant, upper quadrant, and did not touch its midpoint. See that? And then how fast did it run? Where did it go to? Where are the bodies right now? We cleared the short-term high right there, but we're working inside the opening range gap. The difference between Friday's settlement price at 4:15 p.m. and since there's no technical opening price at 4:15, it's the settlement at 4:14, and it just doesn't give you another candlestick when it's regular trading hours, meaning this. See the time at the bottom of the chart? 4:15 p.m. Friday, August 16th. And then the next candle's formation is on Monday at 9:30 a.m. And then we trade up. So we've completely overlapped all this, and we're banging up against the high of the opening range gap, which is the settlement on regular trading hours on Friday. See that? You're spending a lot of time in here. I would not bet against that clearing a higher high. I just wouldn't bet against it. And then we have electronic trading hours, and the chart looks completely different. And it's very confusing for someone, but that's the reason why you have to know what you're looking at in relationship to time. Visually showing price action around regular trading hours and electronic trading hours, you have to get used to seeing that. And also, while you're watching price action, if you're trading like in the afternoon, or if you're trading in latter portions of the morning session and you're on lower time frames, if you're toggling back and forth between electronic trading hours, this is what I'm showing you here now, and regular trading hours, I've done this in the past where I've referenced something, and because I referenced it on either electronic trading or regular trading hours, I mistakenly put more emphasis on something that should not have had the emphasis placed on it. And I discovered, oh, there you go. I made a mistake by having either regular trading hours on or electronic trading hours on. And I messed up either the trade or missed the trade entirely. So that's the aspect of human frailty that's going to come into your trading as well. Just be mindful while you're toggling back and forth. I always tell myself, as a result of those instances, I tell myself out loud as I'm doing, even when I'm not live streaming or recording something, I'll say, okay, I'm back in electronic trading hours. And then I say it again and I double check by seeing it says ETH, because otherwise it'll mess me all up. So remember I was telling you about the Jackson Hole Symposium and the characteristic of that week? What does price do? It overlaps back and forth the previous run. 9:30, we drop down, overlap that entire run here. Okay, we drop down here, overlap the entire run right above this high. And now what are we doing? We're overlapping all this price run here. You see how fast this can frustrate you? Very, very frustrating. And it's explained to you in advance, real time over live price action. Why do you talk so much ICT? Because I want my children, who are always that's the audience of my videos. Every single presentation I've ever recorded, they're always for my children. So because I care about them and I want them to know everything, I give them all of the bits and pieces. And all those bits and pieces that get shit upon and casted aside by assholes that don't know what the fuck they're doing and never will make money. You're a clown to me. You don't change anything. You don't do anything. I'm going to still deliver the way I'm going to deliver because I'm making these for them. And what are we doing? We're re-delivering all of this run from here to here. We're overlapping it. Now watch the wick. This one here, we just touched it there. And the larger one. Right there. And this one. I'm just going to eyeball it like right there. We'll call that low, just below that low, the consequent approach of that wick. So it can spike up with a wick, touch that one. It'd be great if it didn't touch the new day opening, got low, and then rolled lower. That'd be good. You can see a sustainable price run then. So many subtle nuances to trading. You thought it was just buy when it's oversold, sell when it's overbought. Where's the divergence? Knowing how you're going to get burned, knowing how the market will, we just took our low out here, how the market will behave, what characteristics. Remember my lectures around FOMC. Okay, like we have FOMC minutes this week. That's not the same thing as a rate announcement. It's just the minutes. So it's not as impactful as when you do a rate announcement and a policy statement. At 2 o'clock, there's an initial run. And then at 2:30, it usually, not always, usually is going against whatever you saw going into the 2 o'clock run. So it's 2 stages. So it's a 2-stage delivery. So going into 2 o'clock and then 2 o'clock to 2:30, whatever you see there directionally, generally, you have about 70% likelihood that it's going to do the opposite direction and it's going to be extremely much more exaggerated going the other direction. So it'll reverse and do the opposite direction and go the biggest move of the day will be opposed to what you saw going in at 2 o'clock as it traded to 2:30. And then when you do the conference portion of the Pal's like me. He must be watching my fucking live streams and videos because he likes to talk. And he's the longest winded Fed chairman that we've ever had that I can remember. And I prefer Bernanke, but everybody since Bernanke's they get under my skin. I don't like him. I didn't like Yellen, and I don't like Powell. But Powell, he's cut from the same cloth. He likes to talk and talk and talk and talk. But I think if he was a little bit less talkative at the 2:30 session, we'd have really better FOMC trades. Because sometimes he just likes to drag it out, and the more he talks, the more they have to wait to do their intervention. Sometimes you can just see they fed up with it. They say, okay, let's just start running it while he's talking. And it usually is them talking at the conference, the 2:30 portion of the FOMC announcement. Usually the 2:30, they'll say something or open the beginning of the discussion with, and that gives you all that you need for them to do whatever intervention they're going to do, which really, again, 70% of the time is just do the opposite of what just took place and hold on to it. Hold on to it to around 15 minutes after 3. And just, if you look and study that, don't take my word for it. Look and study and see that's usually, that's the winner. That's the thing. But everybody likes to hold on to the close of the day, and you want to be getting out early on. So about 15 minutes after 3. Why? Because that starts your last hour macro, one of 4 macros that are in the 3 o'clock to 4 o'clock time window. That's the only time of day that there's multiple macros in the same hour. There are no 20 minutes to 40 minutes or 30 minutes to 40 minutes. That's all bullshit. Anybody that's saying that, they're just trying to sell you a gimmick. I promise you, that is not a thing. It's not a thing. All right, so now we've taken sell side out below here. Watch new day open gap on the 16th. This is the last attempt. If it breaks this low here, I'm going to move to the sidelines, and that would be enough for today. But I want to see it now start to find some footing. Go back and use this wick here. Why are you doing this now? Like, why are you looking at that wick? Why is it something that you're making a reference to? Why is this fucking fib not moving? How's that for a question? All right, so that is it there. So I'm watching this level right there. If we open on another candle, come back down and touch it or fail to touch it and rally, or just run straight from here. Either one's it's good, but I'm watching this as like an indication of strength, because this level is a discount array right now. Where's price? Up here. Below it, we have what? We have this little bit of a gap. We have the new day opening gap high, consequent encroachment, new day happening. Easy for me to say ICT. So the new day opening gap low, and then below that, we have this balanced price range of this wick and that wick. But in the middle of it, we have this midpoint of that wick there. So my eye's jumping to that. So it needs to, now because it's taken off like it has, I don't want to see it come back down to this level now at all. So let's use this information. Say you would have taken this as a long. I'm not saying you should have. I'm not saying that Caleb should have. But I would use this level here as any stop would have to be below that. And it would have to be below this low here. Because this wick up and this wick down, it's traveled back and forth in here. So that portion right below that, that would be a place for a stop loss. Using the ideas of trailing stop losses, stop placement, that type of thing. I would not be long, but if I were, this is the type of thing you guys are asking me all the time. How do you arrive at where you're placing your stop loss? It's a lot of these things as I'm watching price. And if I see these things start to form and I'm in a move that's going up, or if I'm in a move that's going lower and I see the opposite side and I start seeing these barriers where price has done multiple passes through after it's done something. Okay, well, what is the something that was done? Low, lower low, so that's relative equal lows. Big liquidity resting below that. We dove down below it. So it's been made jagged down here. So where is it smoothed? Here and here. Okay, so now we have a fair value gap there. So this could be viewed as breakaway. This could be a common gap, which can fill in. It can come down and give an institutional order flow entry drill, which is just below this wick. Then leave a portion of it open. It can completely overlap that and close that in. That's fine. I'm going to take this line off because if you remember, that's the old relative equal lows over here. See that? I'm going to take that off because it's distracting me. And it's another reason why, like I said, I don't like to have too many things on my chart. There's the wick. We went one tick below it. Look at the low of that candle. You're looking at this price right here. That candle's low is 580.50. The next candle's low, 580 even. So it went down 2 ticks just below it. Now we're into it again. That wick, that fair value gap is what I'm referring to. Ideally, if it really wants to take these areas up here, it'd be wonderful to see it leave a portion of this open. It can close it, but every fair value gap that we're looking for as a means of supporting or providing a market propellant to send prices higher, supporting it basically, in order flow, we want to see it stay open. Some degree of the inefficiency stay open, because as long as it starts to do that and it starts gaining ground and moving higher, that's supportive to your trade. So how do you hold on to trades and have confidence? How do you hold on to trades and not get scared out? Well, it starts with these types of things. And you still will get stopped out of trades. It's not a be all end all. It's not a panacea. It's not an answer to everything. It's not a magic bullet that fixes all problems for you. It just means that this is what I grow confident in while I'm holding trades, you see me execute and record, and the things I call out when it was on Twitter Space, I'd say, okay, it's going to run to this or run to that, and I wouldn't change my mind. We would stay with that narrative until it delivered to it, and I'd say, there you go, it must be random again, right? Well, the ideas of how price is going to use these inefficiencies as a building block, and then are we seeing them fail? And seeing them fail is a good thing. But see, now, can you hear the jacklegs that would come in to hear me say that? We want to see it fail, and that's a good thing. Saying that, see, he wants his stuff to fail. No, you want to see a fair value gap not completely fill in. What did it do here? Before I went over and showed you the old sell side liquidity, I told you that we want to see the candle here drop down just below that. It did it 2 times and then delivered a run here. That's more than your live streaming guys do. They get out, because they're panicking. They have no idea. They'll call a move. It could go up here. Remember I said at the beginning of the stream? Well, if you're going to say it, why aren't you holding for it? Why do you keep resetting your accounts? Why aren't you doing it? Because you can't do it. ICT, stay focused. I'm focused. Focused on making you a winner. Plus, I got to speak when I have something. Because if I carry it, I'm unsatisfied later in the day when I felt like I should have unloaded on it. There you go. So there's the gap. That's where I told you the institutional order flow entry drill would form based on that candle. We want to see it stay open. What does that mean? Well, it went down as far as that low. Did that low touch this candle's high right there? No, it didn't. So what did it do? It went down one more time and then rallied. But what did it create? This down close candle, which means absolutely nothing, right? It means nothing. Steve Nielsen knows nothing about this. Nothing. This right here is an order block. The high of that candle right there is 19,591 and a half. You're going to look up here, by the way. The high of that candle is 19,591 and a half. The next candle, we trade above it, and then we have the low of that candle right here. 590.75. Did we get the touch of that? Doesn't look like we did. One tick away. One tick away. So if I would have had if I would have had a pyramid entry, trying to get in on that, adding more to it there, I would not have gotten a fill on that. But we gave you the institutional order flow entry drill here and delivered beautifully. So if you're using that as your entry model, so 580 and a half, so 580 and 3/4 or 7.5. So 19,580.75. That would be your threshold that it had the book to. So that means your limit order would have to be right at 19,580 and a half. So if that's the low you need to breach, it does it here by 2 ticks. You're filled on that one. If not, you definitely were filled on this one. And what's your heat? What's the drawdown on that? The difference between this low, it's 80 and a half, so 580 and a half, and the low on this one is 78 and a half. Oh, it just jumped. 78 and a half. So it's 2 handles or 8 ticks. So that's the heat you felt. $40 per contract on a standard contract of E-mini. And then it runs. What's your first threshold? Let's see if it can touch what? New week opening gap, low of this week. That was the low of the new week opening gap, or where we settled, or where we opened rather. I forgot which one it was. That would be your first threshold. And then can it reach to halfway? You measure that out. There's your half. And then you watch. Does it have speed to get to the upper quadrant? And if it gets to the upper quadrant, it should pierce right through the high of new week opening gap. Why? Because these traders that have stop loss orders sitting right at those really smooth highs, they're not going to want to give them an opportunity to do what? Get out of it. Ta-da! Just like that. See how it was like real energetic, punching up there? Get these too many lines off here. Look at the bodies right here. See how they're using that old reference point of the opening range gap? We've already passed through it. See, everybody else that knows, oh, everybody knows about gaps, ICT. You're just reinventing bullshit. No, I'm not. I'm peeling back the layers and telling you what you never paid attention to. Proving that no one else is doing it because they would have it in books, and it's not there. But they're in Amazon books now because everybody out there is writing books about what you're hearing me tell you live. But we passed and closed in that opening range gap here. We passed into it here, reacted off of it, nice, and we went back into it again here. And what did we do? We wicked through the new week opening gap high. And admittedly, I'm very surprised. I thought for certain when it first punched up like that, my eyes got, I was deceived by what I thought was the real quick punch through. I thought it did that, rally through that. But this is enough from the institutional order flow entry drill down here because we're teaching entries. We're teaching what it looks like. What is the logic behind it? Why should it do this or that? What is favorable? What is unfavorable? This is what it should do if it's good. If it does this, this is still good, but it's better if it didn't. You see what I'm doing? This is mentoring. This is somebody that knows what the fuck they're talking about. If you can't find this in your lecture provider, your mentor, your teacher, if you're not seeing that, if they can't do that, you need to unload them. You need to get rid of them immediately because they don't know what they're doing. They're guessing. They're never going to be able to do it in front of you. And everybody says, I will never do these things in front of people. Every time I live stream, I'm giving you the logic as to why the markets should behave a certain way. Tell me where the institutional order flow entry drill is before I taught it in anything. It's not there. No one had that entry mechanism. No one ever did that. No one ever did it. Got $5 million if you can find it. I don't know why you guys are waiting around. Some of you spend all this time justifying why nobody should follow me. And you could be retired if you just simply come forward and say, here's what ICT rebranded. And this is the logic. Here's where the source material is found. This is the book. This is the course. This is the author. And it's got to be before 1996. Why is it that no one can do that? Come on, it's $5 million for fuck's sake. I would stop. I would quit my job. If I felt that sure about it, I would quit my job, pour into everything. Screenshot this, screenshot. I would spend money on credit cards, buying books to be able to go through it and PDF file, print everything, and make a fucking YouTube channel saying, here's what it is. But news, it's not happening. It's not happening. And I have put this bounty out there and raised it and raised it and raised it and raised it, and nobody's done it. But they'll still leave baseless comments, either in somebody else's YouTube channel or someone else's social media post that may be supporting me or saying that they like what they learned here. And then some little shitbagger comes by and says, they're not his concepts. Okay, whose are they? Because I've already went down the list of everything that's everyone said and proved that it's not the case. I'm the original. I'm the original maverick at this. I'm the real McCoy. And that bothers a lot of you people because everything's about clout now. And you can't claim you found it because you've heard me say it. And now you're just an echo. Sorry, but not sorry. So far we've had this area here. Remember I was telling you, watch this area. It needs to get through that. We wicked through it. We went through the new week opening gap. But from here to the new week opening gap high, right there. So we have worked this level there. Let's shade it yellow. Could you not do so much rants, ICT, and just focus on the teachings? It's disrespectful to your students. It's disrespectful to me when you leave comments like that and I delete you because I don't like to be mothered. I'm going to do it regardless of whether you like it or not. So that's what you need to understand. So we've seen it get made jagged down here. These highs were buy stops. They wicked through it. And I'm admittedly surprised that they did not take that. I'm not convinced that we're going lower because they'll be leaving them intact. I don't believe that's the case. what I'm looking at is, do we wick down below the new day, new week opening gap, trade into this balanced price range, and then one more time send it up into here. That's what I would like to see delivered. I'll take this off here. But that right there, son, is one of the elements of how you're going to use the fair value gap. Okay, I did it live, doing it as a manual entry, but when you're watching it form, like in other words, if you're looking at price and it was behaving like this, like that, and this candle is meandering around, as soon as the next candle opens up, okay, as soon as the next, now some of you are going to watch the video right at this point, or you'll cut it and splice it and make a little jab video about me. Okay, but you'll ignore what I said before it happened, because when this candle was forming, we have a little bit of a fair value gap right there. While that candle was active, go back and watch the live stream. It'll be there. I expect to see the market come back down into this little area here, but I don't want to see it close in. That's not me form fitting it, cherry picking it, and just laying it down with smoke and mirrors. It's me saying I want to see it trade with this gap partially left open. So if we're going to use an entry model like the institutional order flow entry drill, which is technically what Caleb's entry mechanism is, you can do it manually, like I showed in a recording earlier in the morning, and I put it on the YouTube channel, and then I called it out loud here and told you where it would trade to, how it would trade, meaning that it would go right below this candle's wick by one tick. By one tick. I was wrong, technically, because it went down 2 ticks. There you go, my fucking fraud. I expected 1 tick, and it moved 2 ticks and left the fair value up. And so none of this shit works. Go watch Supply and Demand Gurus. Okay, go out there and chase Elliott Wave and animal patterns. Go be the zoo trader. Okay, animal patterns. But the wick, that defines your entry, Caleb. So in my interest, okay, for you initially, is I want you to look at that wick low of that candle right here, this one. Once it creates the fair value gap, or while it's forming, you're anticipating, okay? In other words, I was predicting while that candle was still there that this would form a fair value gap. I know you probably don't remember, and you probably didn't pick up on it when it happened, but rewind to that time in the video, which reminded me I'm not writing down the notes when I talk about certain things. This is a lot harder when you don't have a script and you're watching price action. That's why I asked some of you that are more inclined to do those types of things, because you're very, very organized about what you're watching with me and where you can go back and listen to the information. The time when you hear me talk about this gap, this candle was forming, okay? And you would take that candle's low, assuming when the next candle opens, it didn't make a lower low on that wick. So that candle here, we opened up here. So there's time. There's time to drop a limit order in right below that low. One of the things you can do is you can set up limit orders and have them 100 some handles or so away, that all you have to do is just drag them to a location when you're expecting a silver bullet to form, because that's what that was right there, by the way. It's a 10 o'clock fair value gap that is easy to understand, because now you've seen what happened. There's been a disruption. There's been a shark frenzy. There's been this evisceration of orders below that low and that low. We dove down below it. Then the market gets back above. We want to see it touch the new day opening gap high, minimum, or consequent encroachment, or the low, but we don't want to see it go below the consequent encroachment of that wick on a closing basis. Ideally, we don't want to see it trade to it at all. And it didn't do that, right? So that gives me the confidence to say to you while I'm live streaming, do I sound like I'm scared? Do I sound like my voice is shaking? Do I feel like I'm reaching for something? No. This is all 30 years of stuff that I've known, that it's this old hat to me. So it was very easy for me to say that it's going to go below that candle's wick by 1 tick. And I was technically wrong, because it only went down 2 ticks. It went down beyond it, more than I wanted it to, or 4 ticks, I think it was, wasn't it? Or 2 handles, rather. Still, leaving a portion of it open. I was saying ticks earlier, it's 2 handles. So 2 handles of drawdown. Okay, wonderful. It's $40. $40 of drawdown. Okay? $40 of drawdown that was explained to you that this gap should stay open. Why? Because every fucking gap that I'm looking at, I wanted to do that. I wanted to do that very thing. I want them to fail to close in. I'm not Chris Laurie. I'm not trying to see them close in. I'm not trying to see it completely closed back in. I want to see these little cracks in order flow, because this is the real shit that your little horizontal volume bars on the right side of your fucking chart that you're doing. Oh, well, this is the volume profile, and I'm looking for this, and this is the highest volume node, lowest volume node. This is the VWAP. If it touches the fuck the VWAP, fuck the fucking horizontal volume. Listen, that shit has to form. That shit has to finally make its way into the fucking chart before you can start thinking about it. I'm ahead of all that stuff. Do you understand that? I am I'm from the future talking back to you. Okay? I'm talking to you from the fucking future. I'm proving it right here. I'm telling you what it's doing here before it does it on a live stream with 3-second fucking delay. I can pull that off. I can fraudulently do that. Is that what you're telling me? In the witness of all you people here watching me. Really? You give me far too much credit for that. That's amazing. That's fucking amazing. But your entry model, Caleb, is going to be based on this. So that way it completely strips away all of the necessity and the fear of where do I buy it inside the fair value gap. You don't. You buy it at the high of the gap plus one tick. That assures you that you're going to get filled. And it's also doing what? It's allowing you to sit in a little bit of drawdown, and it's normal. It's normal. But what happens if it goes down and stops me out, Dad? Well, that's a stop out, son. I mean, that's what's going to happen to you. You're going to have a loss. It's going to happen. You're never going to evade the eventual losing streak, not single loss. You're going to have a losing streak. And it's going to have to be met with you trusting what you're learning is going to work again. Don't change anything except for the amount of risk. So in other words, you'll drop your leverage, which for you won't have to be messed with because you're going to be doing one contract. You're going to need to trade with 1.5 times the margin for every new contract that you add to your trading. So the whole worry about over leveraging, that ain't going to be you, because you don't know what you're doing. And everybody else out there wants to trade lots of contract sizes, and that's why they fail. And when you have a losing trade, you're going to stop trading for that day. That prevents you from over trading. You can't over leverage because it demands you 1.5 times the margin for adding another contract. You will never over leverage your account. It can't happen. Mathematically, you're denied that. From the perspective of frequency of trade, as soon as you have a winning day and you close your trade and there's a win, that means all partials, if you have gotten to the point where you can have 2 contracts in, everything is now done. You close the charts, you cannot turn them back on until the end of the day. You're not even watching price action, because that way you are enticed to do it again. You're going to learn discipline. You're going to learn to follow the fucking rules. And you cannot fail if you follow these. It will give you the chance for the tools to do what they have been coded to do. Win. Win. Win in surprising and stunning fucking fashion with levels of precision that everybody else out there are learning with you that no one else can match. No one else can match this. No one else can match this. There's no discipline of trading, looking at charts, or technical studies of this, that, and the other thing. It doesn't exist, folks, because this is the market. You're not going to beat the market, okay? You're not going to beat it. The only thing you can do is get in sync with it. That's it. That's the only thing you can do, or survive it by luck. But you're not going to beat it because it's always controlled. And when it's advantageous for them to color outside the lines, pay attention right here. Come down outside of the new week opening gap here, and then price higher. I would want to see speed and distance now, because we've already been here before. So we're knocking on heaven's door. When Guns N' Roses came out with that song, number one, I love the album. I love the group. But when I was doing a MRIC internet chat relay room, I had 1,000 members in there, and right before September 11th, 2001, before all that stuff happened, I was running a room with 1,000 members in it. I was calling the S&P, calling the bond market live, and whenever it would do things like this, where it would get to a level we were identifying, and it would just go bump, bump, bump. It's like, I use the analogy like SWAT. Like eventually SWAT's coming through your door. Okay, you don't have enough to keep them from coming in. They're coming in. Well, before I adopted that mindset, it was like I would always say, knock, knock, knocking on heaven's door, because it's doing everything that leads up to an eventual run up into this area here. Or imagine taking a champagne bottle that's never been opened. It's shaking up right now, and they're getting ready to pop the cork, and that's where the spray is going. Okay, so, but going back to order entry, the I don't know why anybody wouldn't be having fun learning like this, because this is my cup of tea. Like, I would love to have this. You don't need to stay. You would bore me and put me to sleep if it was just the dry, monotonous. This is the rules as it is. But I'm giving you things that support the ideas that leads to what I'm teaching and outlining and where I think the market's going to go. But entry techniques, because the fair value gap is Caleb's, I'm forcing him into that. Not that it should be for you, but if you're going to watch the videos, just understand that that's what I'm doing because he's my son, and I'm exercising my right and authority as his dad to say, I'm telling you what to do. Because you're an adult, you can make all the decisions outside of this, and that's fine. But you asked for this. So it's my rules, it's my way, and this is the way it is. So he's going to learn the fair value gap because it's visual. There are things that, as you'll learn as we go through this mentorship, that you can use the gaps to measure market structure. You can measure the strength or weakness of an underlying move. And that was indicative of what I was saying earlier and what I've mentioned the last 2 weeks in live streaming. Whenever we're looking for a PD array, if they are not traded to, or if they, for instance, like a gap, if they don't completely overlap it, like we were outlining here, I was saying at the time, let me make this a little bit larger, but keep that portion of price action up there so available to us. If we look at what was being spoken about, that gap, when this was forming that candle, this candle had not closed yet. It has not closed. The next candle, I want to see it drop down right below that candle's wick, which it does here. You may or may not have been filled there, Caleb, to be fair, because it's literally like one tick or two. And I've seen it happen with me. I've live streamed recordings. I've live streamed my analysis of, this is what I think is happening. I've had real trades running with $18,000 of profit with AMP, which is a real brokerage firm and not a fucking demo. Okay. And my limit order did not get respected. Was it AMP screwing me? I didn't say that. I've had it happen to me when I was in TD Ameritrade. I had it happen when I was trading with Lynn Waldock. I had it happen when I was trading with Fox Investments. So it's an occurrence that's going to happen to you because you're trying to be so precise. You're trying to be so precise that you have a margin for error for that to occur. So to prevent that from happening with your entries, you're going to use that candlestick's low plus one tick above it. So that means if it books two ticks below that low, you should be filled. Look where it's trading. Somebody's about to punch the air. Oh, you son of a bitch. I was trying to fade ICT. Fuck him. He's a fraud. I can't show the video now. It failed on me. Fuck you. Fuck you very much. Woo! Give me some more ICT. I'm here all week, baby. Tip your bartender. Tip your fucking bartender. Who's doing it like this, Patrick? Come on, baby. Get the fuck out of here. Oh, man. This is so fucking fun. So the fair value gap, we don't need it to come all the way down to the low end because that's what folks that are prematurely trying to teach my concepts, they're saying that you can get filled at the low end and you'll have the best and your stop loss will be micro, short, and small. You don't need that because if if you haven't picked up on what I've been laying down here, knowing where the market's going to gravitate and draw to, okay, where the market's going to draw and gravitate to is more important. Which has more impact on trading, not just your trading, but everyone's trading? Your ability to get in on this fair value gap that maybe not 75% of the people that trade even are paying attention to, or where the market's going to draw to because there's stops resting right up here. Clearly, it's where the market's going to go to. So if we have done the work and we're laying the groundwork and foundation for that to determine where the market's going to go over the course of the session, over the course of the day, which we haven't got to that part yet. So far, we're only working with session draws on liquidity, and they're dynamic. Session draws on liquidity are dynamic. That means it's above and below. You have to start there. You will not know how to derive the daily bias until you get good at knowing how to determine what side of the session bias is going to be the draw. Didn't think about that, have you? But that's how I teach. That's how you learn it. But if you can formulate an entry mechanism that affords you, number one, a high precision entry model, which is obviously institutional order flow entry drill, you don't want to see that gap filled in. But what happens if you get filled and it does close it in, Caleb? Nothing. It just means you have a little bit more drawdown. It's not that much from this candle's high of 76 and 3/4 to the low of that one, which is 80 and a half. So what is that? 5 handles or so? Factor that in with commission. Yeah, you fluff it up with commission costs. You're using, say, for instance, when I say commissions, you're not technically paying commissions through Top Step that I'm aware of. I don't know. I might be wrong. I might be wrong by saying it. I don't know how they do it, but because it's funded and it's basically a demo account, you're really not technically trading and paying any commissions. Not that I'm aware of. If I'm wrong, please accept my apology because I don't know for certain. But what I'm saying is he's only going to trade a prop firm to get enough stake to take that money and go into AMP Global. AMP Global is where he's going to be trading with real money. So he's only using a prop firm to springboard from demo to profitable, making money, and then taking that little bit of money. He's going to stop doing business with every prop firm and then go into, I shouldn't have said it that way because it makes it sound like he's in multiple ones because he's not. Top Step is the only one he's going to go with. He's opened up one before with them, tried to pass a combine or two, I think, and wasn't able to do it. So he's going to make an attempt to go back and do it that way, recoup whatever he spent there, make enough money to put into a live brokerage account, and then he'll be trading with AMP Global. Not that I have an affiliate partnership with them. I have traded through them. They have cleared trades for me. I have nothing really bad to say about AMP that would be like FXCM. Fuck FXCM, and I'm glad they got shut down and thrown out of fucking US. I'll just leave it at that. But AMP Global, every broker is going to have something wrong with them. I mean, nobody's perfect. Would I choose any other broker to trade with live with real money apart from AMP? No, not at this moment. I wouldn't do it. That's my opinion. That is not to say that you should. Okay, so to answer broker statements, to answer getting a broker with real accounts, who would you trade with? To answer the equation of why wouldn't you trade with a funded account? Anything to that vein of thought. If it's dealing with a real brokerage, AMP is the only one that if I had to start all over again, if I had to start completely all over again, which is why I've said this is what Caleb's going to do. I would go through the process of doing whatever I could. I honestly would not be doing a funded account challenge. I simply wouldn't do it. And the reason why I say that is because I can only see it from who I am today. They all would love me to do that because then they have my social security number and then there it is. My whole fucking identity is fucking copycatted by some dickhead that goes through their shit in back order, and I'm in trouble with them because they could ruin me financially. They can say everything they want, but you can't control the thoughts and intentions of your employees. Okay, you can't. And if they have access to that type of information, well, guess what? You've given it to them on a silver platter. Can it still happen in a brokerage firm? Sure, it can. I just feel like it's a little bit more easier to prove who had access to that with a reputable regulated broker than someone that's running a funded account company. Okay. And I'll just say it like that. But I would do whatever I could to raise the money up to put it into AMP. Their margins are extremely low. Not that that's a good thing. Their commission costs are extremely low. That's a real good thing. And their executions have been awesome. Sometimes my limit orders don't get filled. Sometimes, I've been slipped a little bit, but not like wild. Like I got slipped with slippages where you try to get into the marketplace and say right now it's trading at 642 and 3/4, 42 even, 42 and a quarter, 42 and a half. If I bought it, it's filling me yet, and now I'm filling it. So I've got 4 tick slippage. I've seen that and worse with TD Ameritrade. It was kind of shitty over there, to be honest with you. They sucked. So AMP is reasonable. My experience with them is reasonable. If you're trying to trade futures, okay, this is the part where the funded account companies are going to fucking hiss and moan. They're going to create sock puppet accounts and fucking troll me and talk shit about me and everybody else's stuff. I would not try to do funded account challenges or try to do that. I wouldn't do that. Okay, I wouldn't do it. I would do everything in my power to sell, to barter, to work a second job. I did all those things when I was coming up as a 20-year-old. I delivered pizza. I worked on the weekends. I did all that stuff just to get money to fund the account. And anytime I blew the account as a 20-year-old, I would go and do more shifts. I would do it. And I would work and earn that money. But that's not what you want to hear today because you have a millennial TikTok mindset where you want it real fast, you want it easy, and everybody owes it to you. And fuck you because you took too long getting it to me. That's your mentality. And you don't like to hear it being told to you that way, but that's exactly what it is. And you don't like me because I'll call you out on their bullshit and say that's your mentality. That's why it's holding you up. You need to change that. Stop expecting it to be easy for you. Stop expecting it to be handed to you. And I force my son. He works in another state. He has to go 2 hours commute to get to where he works at now. Does that sound like a loving father? It is, because I'm showing him this is what you're going to have to do. It's either that or it's my way. And my way fucking makes money. My way makes your own schedule. My way sits on your fucking ass and says, I'm not going to that man's place today so he can tell me this is all I'm worth for this many hours and I better show up on time tomorrow or I don't have a job. Fuck you. Fuck you and Carl. I don't want to have anything to do with that. And the only way that I can forge that mentality in my children is to allow them to go through work hardening. Work hardening is what made me who I am. I don't like a fucking job. There ain't a job out there that can pay me high enough for me to work it. Ain't no fucking way. I'm unemployable. You can't hire me, okay? You can't. You can't fucking afford me. And that's what your mindset should be. I can make as much as I fucking want. And I can sit as long as I want and do nothing. Tell me who's happy. Tell me who's happier. The surgeon that's making $600,000 a year, that's sweating his ass off 20 hours in a fucking surgery. Yeah, he's got a good salary, but he's paying a lot in taxes. And it's stress. And he has the life of someone else's in his own hands. And the outcome, guess what? If that stop loss is hit, you got to live with that. That's too much stress for me. Fuck that. No way. And I have surgeons like that in my paid group. I couldn't do what they do. I couldn't do that. Emotionally, mentally, I couldn't do it. And their argument was they want to stay doing that and still make a lot of money here. My question is if you can make millions of dollars, why would you want to keep doing that? When you can, if you went into that, not to save people's lives, that's just the derivative. Everybody wants to go into it because it's a lot of money. I can own a Porsche. I can own a nice beach house. I can have a second house. I can have a lot of money. But you still have a job. You don't have freedom. You have to do what that hospital says you have to do when you have to do it. And what's worse, because you're now such a high demand personnel, you could be called in at any time. We have a trauma patient. Look at this. We need this. We need you here right now. We're going to say, nah, man, I can't right now. I'm trading British Pound. I'm trading FOMC. I'm watching this guy on live stream. I can't do it. I can't do it. You got somebody else? No, you're it. See what happens? Because you're an employee. Fuck that. No way. That's not me. So Caleb, he has to see the same thing you're seeing right here. You're watching and observing. You're waiting for the still waters to be disturbed. Watch the water turn red. And then look, where is it smooth? I gave you both sides of the marketplace. That means you're looking at both ends of the session. Because session draw on liquidity, session liquidity is above and below. It's above and below. All you have to do is wait. Wait for them to do the damage. Wait for them to do what's the time window? You're going to see it at 10 o'clock. That means you have to wait that first 30 minutes. Why? Because that is the opening range. That's that vertical line right here. Okay. So when you're watching price action, you're looking all through that first 30 minutes. Your eye is going to, where is the initial legs of liquidity? We gave them to you. Here is the buy side, and the sell side was over here. Here and here. And how far could it reach down, Michael? Remember I was telling you that? It can trade down to that new day opening gap. It can trade down into that. And if it's going to trade through that, we have that low over here, which was in view when I was showing you all this stuff anyway. Then, once it does that, it rallies back up to opening range gap, closes it in, drops one more time, overlaps into all this, the rejection block. You heard me talk about that as it's happening. Come back down, hits the new day opening gap from the 16th, rallies back up in. Look how the bodies are staying there. Remember I was saying, listen to this part, okay? It's spending too much time. It's spending too much time inside of the opening range gap. Meaning what? They're not in a hurry to pierce this high, much more meaningful than they did here. So this high and this high is still relatively clean. That's just tiny. It's little. That's a little bit of movement. That's just like when I was telling you the description when your child's coloring. They color outside the lines. You don't look at that as a failure. You don't say, look what you did that wrong, and smack them for it. You're going to hang it on your refrigerator because it's your child. Well, same thing here. When the algorithm is trading just outside of the lines, it's okay. It's doing everything it's designed to do. To get that price high booked, it's got to go above it because there's a spread. Well, that's all it did there. Did it close above it? No. Did it have much more meaningful movement beyond that? No. Did it trade to the high of the new week opening gap for August 18th, this week's new week opening gap? No. So what is it leaving? It's leaving this liquidity and making these individuals over here feel safe. So what is it going to inspire if it sells off? Shorts to do what? Place their stop loss above here, or if they have deeper pockets, build it right there. So this is engineering liquidity. It drops here. I said take your attention over here to these wicks, here and here. We watched it drop down below it, took out that low. And now I said, now watch. What I want to see is, does it get back above the new day opening gap on the 16th? And then does it come back down and touch that there? Yes. I don't want to see it trade down and below that wick's consequent encroachment. It never did it. Right there, that tells me, and this is what you're supposed to be doing by listening to that you didn't pay attention to because you're looking for something else or you're waiting for me to say something that's going to resonate with you. I'm teaching you how I called that institutional order flow entry drill. How did you know? If I show you all the comments from me uploading that video earlier this morning where I got in the trade, how did you know that? And why are you trading before? Weren't you supposed to wait for relative equal highs? Weren't you supposed to be waiting for relative equal lows? Again, you don't know what I'm putting the content out there for. I'm addressing individuals that are paid students. How can we, that know a little bit more than the average bear watching my channel, how can we use this model if we don't have a model that we've really warmed up to? Specifically, 2016 students. I have 2016 paid students that can't find their way through this still. No matter what content I bring forward, no matter how many people are making money with it, with real money, with real results, proving it is happening, calling it live, they can't make it work for themselves because there's some kind of a barrier. But their question is how can we, I know that they know a lot more than Caleb does. But the questions are, how can they use this methodology and understand how to use the range that was formed in London? If you go back and listen to what I was talking about, if you're brand new, you don't know what you're doing, and like I'm telling Caleb, you don't worry about this. You don't worry about this. You wait for 7 o'clock and you look for relative equal highs and relative equal lows. Well, guess what? That's this, folks. That's the relative equal highs after 7 o'clock. Right here. Here's 7 o'clock. Okay. It rallies. We're waiting. 9:30 opening bell. All the way to 7 o'clock. You're going to look back through that. So if you're going to not be an early trader, you're not trying to trade early. You're going to start looking at the market at 9 o'clock. Go back to 7 o'clock. So you're looking back through the last 2 hours. You only have to look back through the last 2 hours to see where the liquidity is. So here at 9 o'clock, right there, what do you have? High that's lower than that. Isn't that a relative equal high? Listen to the definition I gave you in the previous teachings. Yes. What are these? Relative equal lows. So what is it doing first? It runs above these highs there, and then creates what? Another smooth relative equal high. But then what does it then do after that? It breaks lower, takes out the liquidity here, and we're watching the opening range. What's it doing? It's finding responsiveness at the midpoint. It has no ability to get to the upper half of it. So what's it going to do? Go back further to 7 o'clock. Anyone that has more advanced understanding, listen to the lectures I gave prior to this week, where I'm talking about the relative equal highs and relative equal lows, and I'm telling Caleb, you only wait for the 7 o'clock and anything that forms to the right of that. I have students that will be able to use the information that is in price action prior to 7 o'clock in the morning because they know all the things that I taught them around London and how they deal with the opening and closing of a daily range, power 3. They're going to incorporate that part of the range. So that lesson was just simply me saying, this is using Caleb's model, and you know how to use the other stuff I've taught you with London. The things I'm talking about and referring to that are already on the YouTube channel. Go watch the mentorship videos in 2017. The 2017 mentorship playlist. The students that paid and went through those lectures live as I was delivering them, as it was happening, and I was doing live streams and calling markets and saying this is what's going to happen, doing market reviews, saying where it's going to go next. Those were the individuals I was answering and addressing to there because they want to know, is it anything here for them or should they just stick with what they got? And I have students that don't find their way well through the marketplace still because they have something, and I don't know what the barrier is for all of them. I don't know what it is. Okay, sometimes, they're very clear and showing what it is, and others are just, I don't know if they're just guarded and they won't be honest with me and say, this is what I keep doing, but I haven't been willing to show you this. I keep making this mistake. So if you're going to ask me as a student, and I'm not saying you should do this because I still get emails from people all around the world saying, hey, look, can you tell me what I'm doing wrong? Or can you look at what I did here and tell me I did it right? I shouldn't have to do that. If the outcome was positive, you did something right. If the outcome was not positive, you didn't do something right. So explore. I'm not going to cut you to the front of the line of your learning curve by doing it. And I know some of you just want an interaction with me on an email like I'm a celebrity. I'm not a celebrity. I'm not important. I'm not that great of a person. Just be content with what I'm teaching you here. Stop trying to lift me up to a celebrity status. I'm not that amazing, okay? But anything prior to 7 o'clock, well, what does that take you back to here? There, which is what I referred you to when we were, entering into that 9:30 opening. Where's the liquidity at? Here and here. And what did the market do? It addressed what side first? Here. After 9:30. That's here. Right there. So did it go for that liquidity or the sell side over here? Which side did it go for? It went for the sell side first. Came back up. Did it take that liquidity out yet when it was here? No. Did it take it out right here? No. So where'd it go? It went below one more time here. We were looking for it to sweep down to here. Then as it was dropping down, I said, watch these wicks in here. It overshot the entire low. That's fine. We're not in a trade. We're not getting stopped out. We're not getting squeezed out. We're observing and watching. What are we waiting for? We want to see it take that low out. Drops. What is this forming? Relative equal lows for anybody that's trading to 9 o'clock. Going in, waiting for what? The first 30 minutes opening range. High, high. Relative equal highs. In an area I told you this is going to be problematic. We need to study this. It's going to need to get through this little area here because there's two indecisive candles. Even though that this candlestick's closed and this candlestick's open, is basically symmetrical. It's close. It doesn't really provide a gap. When I see candles like this in the middle, two of them like that, that to me is something that needs to be repriced to. And if it goes through it in the direction I'm looking for it to move, then I'm fine with it. Then I'm going to disregard it and never worry about it again. But go back and listen to it while we were trading here. I said it needs to go through here. And it couldn't do it. Went lower, lower, rallied one more time. The body's staying inside the opening range gap. Just bumped that high and then took us down to clear this. I told you once it done this, I want to see it trade above the new day opening gap on the 16th. Come back down, touch that, and it did. And then I gave you, because of all the things I just outlined, which side did it work predominantly? The sell side. What is the side of the marketplace usually offered to the public first? The wrong side. They take them down the primrose lane. Okay. There was a song my grandpa used to listen to. I don't know the artist. It was an old singer, but he used to play every time he would get drunk. He would sit there with his boxer shorts on, nothing else on. Well, that's not true. He would wear white tube socks and a pair of boxer shorts, his underwear, and he'd sit there with a half a gallon of ice cream, butter pecan, smoking Lark's cigarettes, and watching Gomer Pyle, drunk as shit. The TV would be on, and this guy would be singing something about going down the primrose lane. Well, in the market, they send the traders on the wrong side. That's the Judas swing. That's the run on price action that gets people thinking, this is where it's going. I want to get on board, and they chase it. And if they're initially positioned to profit while it's forming, it gives them a sense of like comfort when you shouldn't be comfortable. It's usually the wrong side of the marketplace. And then it comes down, takes the low out. And remember I was asking, do you feel safe if your stop was here? That's me priming you. I'm priming you as a student. Okay, he's taking my attention up here. And I said, now what about the people that had their stop loss here? Who's made money right now? Shorts. Anyone long from that low is now unseated. Why did they do that? Because they're going to go here. So to run from here to here is profitable. To run from here to here is profitable. And why it went down there is to unseat the stops that were resting right below that low. I took your attention to this area here. Told you the fair value gap was going to be there before that candle closed. One tick below this candle, that's the institutional order flow entry, Joe, and we don't want to see that entire gap closed in. That gap looks like this. That's your fair value gap. It went down to this low. Is that still unfilled? Of course it is. That's exactly what you want to see as a signature. That is the algorithm tipping its hand to me because I know what the fuck I'm looking for. When it does that, it's going to be what I want to see. We want to see it rally up. Where is it going to rally to, Michael? New week opening gap low. And then we want to see it trade into the midpoint of that consequent encroachment. And does it touch the top of it? Look at the bodies respecting it again. Yeah, we wicked through it. And admittedly, when I said 6, yeah, boom, it happened. I thought because it flashed real quick, my eye was watching that. This line, I thought that was this over here. And it had to dig down. And I told you, okay, I want to see it go down into this area here. And there's a balanced price range in there. So it can do that and then send it higher. Does your chart show this? I'm quite fucking certain that your chart, if you have live data feed right now, or if you're watching it after the fact, you're now looking at the same thing that's on this chart. And you're going to tell me that we don't know what the fuck we're doing around here? Like this is completely random? Like it's random. We're looking at a 1-minute chart. Every fluctuation of any significance is being outlined. The logic as to why it's going to go where it's going to go. Pray tell, where's the fucking book? Where's the authors before 1996 that was outlining anything like that? And it happened. And there was nobody doing it while I was becoming who I am today. November 5th, 1992, that was when I started on a Thursday night at 9 o'clock in a house in Bird River, Maryland, renting for $50 a month. Or I'm sorry, $50 a week. Room and board at my aunt and uncle's house. And I started to learn how to be a trader November 5th at 9 p.m. on a Thursday night. And between then, all the way to 1996, that's when I had everything as I wanted it. And then I tinkered with it for a little bit more after that and it prolonged the progress. But I had it figured out in 1996, around April of 96, or thereabouts. It was springtime. And I was looking out over the water in Gunpowder State Park. I used to go out there and listen to CDs and tapes and audiobooks and stuff, not about trading, just usually it was like Stephen King stuff. And I'd have my little Walkman headset, and it dawned on me that I have cracked this shit. I figured it out. Like, I have it. And it was my moment of astonishment that I have arrived, and I didn't realize it until that moment. And I wasn't even looking at charts when it happened. But all of these things in price action, they're going to repeat. They're going to repeat. But I have to walk Caleb through this and prompt him to say, okay, do you see this? You see this? Watch, observe what happens when it does this. Watch, observe when it happens to do this. When it's time to move, you hear me tell you. You hear me. But I'm not going to hold your hand and say, here's a buy, put your stop loss here. That's not what I'm here for. But that's what most of you want happening. And because it ain't happening that way, you're going to talk shit. Because you think, number one, either you're going to feel good about having done it because it's a release for you, or that I'm going to read it, get inspired by it, and say, okay, well, this is reverse psychology. I'm going to fall victim because I'm a moron, and I'm going to do what you want me to do because you're pulling the strings. You're no marionette master over me. You feel in charge? You feel in charge of me? No, nobody's in charge of me. The Lord is. But these things that will repeat over and over again in price action. The logic of waiting for the sell side and the buy side, once you define what they are, just wait for the first one to get taken. When that water is disturbed and you see violence, jagged, 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 the whole time, these are smooth and this is smooth. Oh, I want to be able to buy down here. Well, when it goes below that, you buy it then. Learn from that. Sometimes it'll be great. Sometimes it won't be. We want to see it trade above the new day opening gap. That means I'm saying that once it gets above that and it starts to trade here, as long as we don't breach that midpoint of that wick right there. Why? Because we've had the stops run below that low in here. So this movement is what? It's a wick on a higher time frame. It just doesn't look like one. It's wicking here to take us below that low and that low. So this low is the low that forms what? These relative equal lows. And it's also being respective of the new day opening gap. See the bodies? Is this one doing it? No. Oh. See, that's logic. That's logic. I'm not going to refer to this one as we go back above it as support. I'm going to use this one because this one here is already showing that it's done what? It's respected it. So the algorithm is going to go back to that one. It's not going to refer to this one. Which one was on the new day opening gap? And the bodies are showing it right there. So now my attention was focused there. We went above it. I'm going to see it trade down, touch the opening. I'm sorry, the new day opening gap high. And it can trade as low as that low one, but we don't want to see it close below that wick of that candlestick's midpoint or consequent encroachment of it. And it only gave us a touch of the high of the new day opening gap, rallied, showed displacement. Wonderful. Next candle as it's forming, this is going to be a fair value gap. Called before it formed. Institutional order flow, called before it delivered. I was off by 2 handles, 8 ticks, or thereabouts, or 7 ticks. Would it be 7 ticks? We'll just call it 2 handles. It did not close in that gap, which is exactly what I told you. That's ideal. And then it's off to the races. Look how it responded off of the consequent encroachment of the opening range gap there. Isn't that beautiful? I mean, when you see that, doesn't that just get your fucking juices flowing? Like, this is stuff that once you study it and you see it and you're able to see it, your eye's going to jump to it. And then after being able to see it in hindsight, where your eye jumps to it, you'll be able to predict it like I'm proving to you. Because you know what it's trying to do. You know what handhold it's going to have. If price was personified as a rock climber, okay? If it's a rock climber, you can look back over here and see what it's going to place its hand in, and or what it's going to place its foot in. I told you it's going to go down into this gap, this fair value gap in here, pull down into this balanced price range. Go back and listen. I can't edit it. I don't re-upload the live streams. Once they're there, they're there. Trades into it there. Only by the wick. Consequent encouragement sends us. Boom. Heartache. Shorts are unprofitable. Longs that bought in here, knocked out. Who made money? They cleared the table, both sides. When you're watching me, don't try to predict why I'm trying to say something. Just listen. Take notes. Because you're not going to get the lesson until you go back and watch the live stream after the fact. If you're just watching it one time through, you didn't learn shit. You observed. Some of you are just looking for me to do something wrong. That's a waste of your time. I'm tickled that I'm wasting your time because you're not here to learn, and you're wasting your time. I'm doing this, and it's profiting my son. It may be profiting a large number of you that are watching as well, but that's just something extra. That's not my motivation. My motivation is proving that my son over time can do what I'm able to do. Even if it's 5% of what I know, that's enough to replace his job. If he can do 25% of what I know, he's wildly rich. He's got to wait for it to build up, that's all. But if you're going in here watching me to learn how to quickly get money, to quickly make money, to quickly blow your accounts to stratosphere levels, you're thinking about it wrong. Your idea about making money is going to surpass the necessity for you to be humble and just take in information. That's what he's doing. He's not trying to predict what it's going to do. He's listening, he's observing, he's watching me. He's watching me do this side by side right next to him. He's watched me take the trades. He's watched me make your fucking annual salary in one trade. He's watched me do that. But he's also unaware on how to do it himself. So this is how I would talk to him. I would not be adding anything extra than what I'm doing here. This is exactly how I would talk to him. When it's something that's salient and it's meaningful, it has an impact, or it will have an impact on his growth, and what he'll probably be wasting time if he falls victim to worrying about this and not paying attention to the things I'm talking about. If he doesn't listen, it's going to take him longer. If he listens, applies the things I'm showing you, the logic, these things you'll see, they will repeat. And because they're repeating, and because I'm here every single day over top of live price action, outlining them, explaining them to you. I mean, think about it. How many things are you seeing happen every time we get a live stream going? You're seeing fluctuations in price action outlined beforehand. Is it every single candle providing you a trade? No, and that's exactly the point. That's the point. He's going to see, oh, this is the thing I'm looking for. There might be some wiggle and waggle in price action that he can see coming, and oh yeah, but that's not a trade. But isn't it funny how when it's time to put the money in, we're going to see a gap stay open, an institutional order for entry. We're talking about entries this week. Did it work? You tell me. You tell me, exposee. You tell me, Mr. YouTuber, trying to make money with affiliate links and talking to other fucking people, you fucking clown. Come on, you tell me, is it working? Am I throwing my career away? Am I out here clowning you? You fucking retard. Get the fuck out of here, you fucking piece of shits. Students that stay here and learn how to do this, they will be laughing at you like I laugh at you. Because once they know how this is done in their own hands, nobody's going to convince them otherwise. Because this is the truth. This is the market. And there ain't nothing better. Nothing's going to be better than this. How the fuck can you improve upon perfection? How can you? You'll know when to do something, when not to do something. You know when the market's going to behave a certain way. You talk about volume profile. That's really a poor choice of words. Because if I say a market profile, invariably, some of you are thinking, oh, well, he's just renaming volume profile. No, what I'm saying is there are schematics on how the price will behave a certain way on an individual session basis, on a daily basis, on a weekly range basis, and on a monthly range basis, on a quarterly basis, and for the year. I know that. If I didn't know that, I couldn't sit here and tell you when certain things are going to form on a 1-minute chart, on a 15-second fucking chart. How could that be possible? How is that possible unless I know something that nobody else fucking knows? That's not bragging. I'm forcing you to make a critical assessment here. Are you paying attention? Because clearly this is not harmonic bullshit. It's not supply and demand. It's elements of time, then waiting for price to do something as a response to what's done at a specific time. You're waiting. And to make it very, very easy, to make it very simple, I taught my son to outline the liquidity above and below the marketplace and wait for the first one to be taken. And then the second one will come later. Because the first one shall later be last. That's in scripture. That's the same thing you're seeing in the marketplace. This liquidity was saved. And what you're going to learn, the key takeaways, Caleb, is if this is going to be taken second, that means it's going to potentially move a little bit more beyond this one. Meaning what? If you know that a daily range, and I'm going to draw out a crude depiction of another daily candlestick here, or not a candlestick, but open, high, low, close. If you're enjoying this and you're making leaps and bounds in your understanding, or just entertained, this is the time when you do the thumbs up on the channel. On this video, if you click the thumbs up, that means that I connected with you on a level that has helped you understand and inspired you to stick with it. If you don't put the thumbs up, I'm still going to keep doing it because that means that you want me to stop, and I'm going to deny you. Okay, I did this the last time. I guess it's too small for me to copy it like that. I'm sure there's probably an easier way. Just clone it, ICT. I heard you. But if I still move it, it's going to act wonky. All right, so think of this as a individual bar for a daily chart. Okay. So in other words, it's representing the highest high and the lowest low of the day. Okay. And say in your mind that you're looking at the market and you're studying weekly charts and monthly charts and daily charts over the weekend before the market starts trading on Sunday at 6 p.m. I'm going to save this portion here, and then we'll drop down to a 15-second chart and look at the fluctuations, and then I'm going to close the session out because it's getting a little bit too long. No, keep going long. I want to, but I want to keep it small because my son doesn't have a lot of time after he works to watch all these things. So I have to be a little bit more economical with my time as much as I'm pouring into it, but I'm doing it every day. So he's actually behind. So he's not watching these in the entirety from the beginning to end because he's working. And I don't want him to get in trouble while he's watching my stuff at work. He shouldn't do that. So that's kind of like where I'm trying to aim for going forward. And it's a little bit complicated because you're going to eventually have to trade the whole session, right? So you have to have at least the entire session in the live stream. to talk about what it is and what it isn't. But if this is the daily range, okay, not a candlestick, but an open, high, low, close bar. So this is the open. This is the lowest it made for the day. And this is the highest it made for the day. And this is where it stops trading. Okay. If your thinking is that we're probably going to move up over a series of days or for the week or for the month, or we're moving in that direction higher. Okay. And you're watching price action at 9:30 here. And you've defined, as we did here, the sell side was here. We incorporated that old new day opening gap, and we gave you the buy side. So if we're opening right here at that candlestick's tick opening, let me go back over here. If that opening price on that, I'm going to move this vertical line so you can see it better. So that opening, we opened, went up, closed down. That opening right there represents this graphically in my diagram, okay? And then from that opening price, that movement from here to that low would represent that low on the daily open, high, low, close bar. So what we're saying is the open and the initial drop down, that's the fake move. That's the Judas swing. That's where smart money buys, okay? Now, the complication comes in at where you are going to be a buyer. I don't expect my son to be a buyer down here. I don't expect him to buy the rejection block. I don't expect him to buy down here below that low. That's too much of an expectation placed on him. He's not. It's going to take him a long time to try to buy below here. I can do that. Clearly, you can see I've done executions with live accounts. Proved it they were in live accounts. You can see it there. Signed in to my account. It's on this channel still. Right in the TD Ameritrade showed every single day what the broker statements were showing. Every single day. Okay, it's there. People that want to talk about I don't trade with real money, kiss my fucking ass. I'm out here doing it. What the fuck are you talking about? But that opening price here down to that low in that area, that range, that means where this low forms and where the opening is, you're hunting. You don't have to have the low tick. You're just hunting something to be long. You can feel confident that when you're working towards holding on to trades that pan out longer term. Patrick Whelan, this is for you, buddy, because you need to learn how to fucking trade. This movement from the opening price, I just shocked him right now. He's like, what the fuck? You just called me by my name. Yeah. Your listeners need to support you too, not troll him. You should encourage him, because if he starts doing stuff like this, he'll start making real big money. Real big money. And he'll be amazing to watch live streaming and doing it. Okay. But this opening price down to that low, that range, okay, graphically looks like this. That little sweet spot right here inside that range, that's where your best opportunity to buy and hold, and just wait until we get to the lunch hour and then measure out where it can retrace. So if there's going to be a lunch macro, if it's going to go lower, you can determine where it's going to go lower. You can determine that and not place your stop loss within grasp of that. Ideally, what you want to do is learn to try to enter when you're bullish longer term, when you think it's going to go higher. So don't think that this is a one-trick pony, intraday trading only, and you can never use it to make bigger money. You can, but you can't appreciate this type of daily candlestick close until you first learn how to read these intraday price fluctuations. Because by doing it this way, number one, you're going to get a lot of exercise. You're going to get a lot of price action to digest and learn from. Because everything I'm showing you here is fractal. You can apply it to a weekly chart. You can apply it to a monthly chart. You can drill down to a 5-second chart. It's still there. What do you want to do with it? How you want to frame your model? But for folks that want to use this for longer term, holding on for the longer term range, and the reason why I'm teaching this is I got criticized by students that actually are paid students too. They're like, you said in our lectures that days that go up are a classic buy day. Yeah, but you can't participate on them if they make this low before 8:30. I'm sorry, before 9:30's opening bell, and you're trading at 9:30 and you're streaming at 9:30. How the fuck am I going to teach you how to use an 8:30 entry if I'm starting the stream at 9:30? So I can't go back in time and put myself in the trade. And clearly, I can't do that. But for those individuals that know that this is what it looks like, not every classic buy day or classic sell day where it's just one direction, that's not the same. A classic buy day is just, it moves up and closes up high. It doesn't mean it's one direction with no retracements. There's sometimes it's like that, and if you're able to hold on to it, they're very, very fun. And I'm teaching you how to do those types of things right here, right now, addressing paid students that question me critically, I might add, disrespectfully, I might add. If I was Negan, you'd get a fucking molten hot lava shit poured over your fucking head because of that. You better talk nicely to me. You better remember who daddy is. So we have the opening, which is that price there, and any movement down. We don't need it to tell us in advance what the lowest low is. See, that's the part that's going to hurt you, because you're thinking, I need to know how to buy below the opening price, because that was my biggest challenge, because Larry Williams said he couldn't determine how to do that. So he would buy strength breaking above the opening price. And every time I did that, it would hurt me because it would retrace back down in, and it would crush me. I would get stopped out because I was over leveraging in my 20s, and I wanted to get to the end of the game where I didn't have to have a job. So I was doing all the wrong things. I was putting all the emphasis on all the wrong shit, hoping that I could get myself around all the adversities that I knew were likely, but I just put blinders on, saying I'm not going to be subjected to that. It's going to work for me. I'm going to get lucky, and it didn't work like that. I had all the same things that happened to you happen to me, but it happened in much more stunning fashion because I was willing to put more money in constantly and trade without any stop, without any measure of concern about it losing. I only saw the potential of winning every single time. So that's toxic, and you got to avoid that. But at the opening price or below, that's what Larry Williams was saying. He couldn't figure that out. And he facetiously said, I don't know if he knew the addresses or not the address, but the zip codes of the traders that knew how to do that would be helpful. It was a facetious statement. But I was like, you know what? Here's my hero. In 1995, I'm watching this man who went out there in public, physically took $10,000 to $2.2 million, fell, got hurt, and then traded back to $1.2 million. And everybody said it wasn't real, it wasn't a real event. It took place, man. He did it, okay? So that was my hero. That was everything he said. I hung on every word, like some of you do with me, and please don't do that. Never meet your hero. Never look up to your hero and put them on a pedestal, because eventually you get more information about that person. You'll find out they're not as heroic as you thought, and it hurts. It hurts. And I'm not saying anything bad about Larry. I'm just saying that I took his public statement about what he was unable to see in price action, and that was the invitation for me to say, that's the thing I'm looking for. Because if he can't do that, I'm going to go in. If anybody on this fucking planet is going to figure it out, I'm going to. And I did. And I teach it. It's power 3. So if we know the opening price, that's a finite number. They're not going to move that around. It's right there. It's the opening tick on that candle. Then simply wait for it to drop. Aim for liquidity or aim for any inefficiency below that price to the left over here. Okay, the first stages were the sell side liquidity and then that new day opening gap. It pierced through both of them. And then what did it do? It came right back to opening range. And then I said it was spending too much time into it here. And then it drops, takes out that low. Then I took your attention to that wick, the midpoint of that, and we want to see it get above it. Treat the old new day opening gap. Now, let me ask you something. If you didn't know about the new day opening gap, why would you expect this candle to drop to that level right there and then send it higher? Why would you expect that? You fucking wouldn't. You would have never expected that to happen. That would have never fucking happened. But here it is, good old ICT, sitting here 52 years old, could be sitting on a fucking beach, sipping on some pina colada, non-alcoholic, relaxing. I could have been doing anything else but this. And I'm explaining it to you beforehand. For free. For free. No fucking course payments required. Taking your attention right there, it's going to form a fair value gap. And it's going to be an entry that's an institutional order flow entry drill. That means it's not going to close the gap in. It's going to leave a portion open, and then it fucking does it. What's occurring? This fair value gap with the institutional order flow entry drill and leaving that gap open, where's that forming in the context of the daily range? based on this logic over here. It's inside that open to the low. Open to the low. Look, I'll use the same thing. Graphically depicting. I'm not predicting the closing price. Don't get me wrong. I'm just saying if you go in every single day with this logic while you're learning how to do it better, this is how you grow in holding on to trades. And eventually you are going to catch a fucking tiger by the tail. And baby, when it starts running, you better hold the fuck on because you're going through all kinds of shit. Sticker bushes, water, dry ground, rocks, tear your ass all up. It's going to be hard to hold on to it. But at the end of the day, when it closes like this on the days that it does it, man, you've made tons. You've made tons, and that fixes all kinds of screw ups. It fixes all kinds of drawdown. It fixes all kinds of days where you did too much and you gave back wins. It fixes all that stuff, and it smooths out your monthly equity curve. So I'm not pushing my son into taking trades that it's just 10, 15 handles, 20 handles, and yeah, you're a success. You can, and it's going to prove to him that you don't need anything more than that to make your job. But eventually he's going to be forced into trading like this. See, this is my son. I want ICT 5.0. Fuck 2.0. We're going 5.0 because I want him to be a fucking freak. I want him to be able to go in there like I can and say, this is what's going to happen, and this is why it's going to happen, and I ain't worried about it. It's going to happen. Boom. Done. He can go in there like a fucking money tree, walk out back, pluck some fucking Benjamins off the fucking branch, stuff his pockets, and go fucking spend it, and not worry about the price tag. That's what I want for my son. And if you think that's arrogant, you think that's narcissistic, go fuck yourself. Because why would you want anything less? It doesn't mean it's evil. That's what the devil wants. That's not biblical. People that send me stuff, God doesn't want you trading. He literally teaches a parable about giving a reward for people that do the very thing that we do. We're investing. We're not gambling. Does this look like fucking gambling? Knowing what you're looking for, waiting for the criteria to be met, and then having sound logic saying it should behave like this, and then it does inside the range between the open down to the low. There's your fair value gap right there. That is your low risk buy. Oh, and you did it live. You outlined the details live. No hindsight, no edited, out here in front of everybody. It either works or it doesn't. I either do my victory lap or I fall on my face. Which is it? Which happened in your chart? Fun, isn't it? So eventually what happens is by entering like this, when you have a longer term bias that you derive from a monthly and a weekly chart. See, eventually Caleb's going to determine where in that spectrum his trades should be focused on. So if you're bullish longer term, and you think that this is the criteria that the daily candles are going to form, or the day that you're trading is going to form this. So this is basically like 5 o'clock or 4:15 Eastern Standard Time, that closing price. In relationship to where you opened up at 9:30 down here, that's bullish, isn't it? So how can you hold on to those trades without having a whole lot of fear, anxiety, or oh, I'm scared I'm going to get stopped out? You have to determine how to buy at the open or below it, because rarely will it go back down after it runs up here. It rarely goes back down here. If it does, it's probably not going to create this condition here. So why do I teach you to take partials? Because you don't know when it's going to turn on you. You don't have the advanced understanding. You don't have the experience. You don't have the time invested in knowing how to navigate price. You don't know. You're going to react to everything adversely. Everything. When you're making money, it's going to scare you shitless. You're going to know what am I supposed to do? I was hoping I was going to move up 20 handles. It just jumped 40. I didn't put a limit order in. What the fuck do I do? I'm making more money than I'm supposed to. What am I supposed to do? That's a good problem, but you're going to get panicked by that. And you're going to hold on to it too long because you're not going to notice that it's caused a reversal because you don't have the experience. And that's the first time you made big money. These are all lessons that you're going to walk into and discover, wow, I didn't know that about myself. I didn't know I was going to handle it that way. You think when you make money, it's going to be, oh man, I'm cool. I'm chill. Shit. Man, I ain't got nothing to worry about, bro. It's this everyday thing around here, man. The whole time you're shitting bricks because you've never felt that before. You're panicked. You're your heart's tacking. 130 beats a minute. You can't catch your breath. You're hyperventilating. Your body's tingling. You feel like you're going to pass out and throw up and shit yourself all at the same time. Welcome to profitable trading for the first time, because that's exactly what it fucking feels like. You've never been there, and nobody can adequately describe it. That's the closest thing. When you get there, you're like, damn, he was right. And when you let go of that moment and you let it turn into a loss, man, does that suck. So I'm trying to prevent that. I'm trying to prevent that whole escapade, because it holds you back when you have it, because it creates scar tissue. So by entering in after what side of the marketplace and its liquidity. Remember, we framed it here. This is easy, folks. I don't know what the fuck you people are complaining about. Relative equal highs and the relative equal lows I gave you this morning. Which one does it hit first after 9:30? Bang. Okay, so what does that tell you? That's the first stage of catching a power 3 day like this. If you're going to try to hold for a long, big up close day, it has to drop down and take the sell side first. It did it this morning. But see, look at how I'm teaching my son. Look at how I taught the mentorship. The paid mentorship is the same way. It's the same way. Listen to the liquidity conversations I have in there. The buy side and the sell side. Now, Johnny Assmunch will sit there and watch this stuff and say, hey, see, he's calling both sides of the marketplace. He doesn't know what the fuck he's talking about. You're an idiot. You're a fucking idiot. You're a clown. You don't even listen. If you're going to troll me, at least do the fucking due diligence of listening to what I said, get the framework, and then go in and prove it doesn't work. That's how you do it. But see, you can't do it that way. So you got to take things out of context, because 90% of people that have any familiarity with me that are not my students, they'll say, oh yeah, it's an ICT guy. He's hindsight. He's demo baller. He's whatever. Because they heard everybody else's opinion about it. And they never sat here and was a student. They never put themselves through it. But if you take the sell side first, that's the first qualifier for an up close day. Because what is it doing? It's tricking people that it's going to go down. That's the Judas swing. The Judas goat is the goat that leads the lamb or the lambs into the slaughterhouse. There's a little pathway that the Judas goat is trained to take a little detour, not go in the slaughterhouse. But the sheep are stupid. They're following the opinions of other people that are not students of mine, that have something to sell, and they want to deter you. They want to take you away from it. They want to lead you into their slaughterhouse. Who do you want to fucking believe? Who are you going to believe? The guy that's literally sitting here for fucking free, teaching you how to beat the shit out of these fucking markets with a level of precision that none of these clowns can even come close to, and explaining it over a 1-minute chart, real time, with a 3-second delay. And I can't speed it up anymore, baby. That's the fastest that YouTube's going to send it through its servers. Or you're going to believe the guy that says, oh, this guy's an asshole. Here's my affiliate link. Hope you use my broker because you can help me out and support my channel. Who are you going to believe? Who is teaching what? They need their money. I am not asking for shit. I don't give a fuck whether you use my stuff or not. I don't care. Because it's going to keep working regardless of you using it or not using it. And the more people using it, guess what? It just means there's more witnesses to the fact that it's fucking working. But everything is a graduated understanding. When Caleb sees that the sell side's taken first, okay, that means it's going to reach for the buy side. But I can't take him into a lesson that says, look, son, when we're bullish, well, what makes us bullish? Well, what we just watched today, it took the sell side first, and then it reaches for the buy side. After seeing that for days, weeks, and months, you get comfortable with that idea. You don't need somebody else to tell you in another video. You don't need ICT to answer your question about the bias because you've already seen it. So then the next graduated step is holding through lunch. Aim for 130. Close your trade entirely at 130. If you're in profit, close it. And you keep doing that. And then eventually what you'll do is you'll watch and see that eventually you'll start seeing the days that do these types of things, they close near their high, but just off the high, like it does here. And you'll see that during the last hour, it creates that far extreme high. And then right before close, it comes off that. And that closes just a little bit below where the highest high was for the day. So if you do your work of buying below the open, at or below it, and I gave you that real time here today, in such a beautiful, beautiful tapestry. It's just beautiful, isn't it? See how all this stuff fits together? And some of you think this is complicated. Well, it's complicated because it's going to require some fucking brain cells, okay? And it's going to require more than 30 seconds of spending time looking at it. I'm not TikTok, okay? The logic of following this to its completion, you have no idea where you are going to be as a trader. The leaps and bounds and the depth of understanding you're going to be able to have using this information. Once you have it, no one can take it from you. No one can diminish it. No one can talk down to you. They can't strip it from you. They can't demoralize you. They can't make you doubt it. You'll never fucking doubt it. You'll literally walk around with a fucking raging heart on, and you may still be a fucking female, but you're going to be horned up on it because this is the real shit. You will never be scared of the market. You're never scared of it. Will you respect it? Abso-fucking-lutely. But you won't be fearful of it. You won't be fearful that it's going to stop working. It's going to keep working because there's asshats and dumbasses always coming in the marketplace that want to follow indicators and some bullshit Mickey Mouse logic that's sold in books and course seller stuff. There's always going to be some kind of fucking gimmick that comes out and so, oh, well, yeah, I was a so-and-so. I was an ex-ICT student, but this guy's Lux Algo indicator did it for me. And Lux Algo, I know you haven't reached out to me or anything. I'm not shitting on you. I'm just saying you make indicators. Okay, and I make a lot of unique indicators with my own stuff in it. Some of it ain't right, some of it's close. But the point is indicators by themselves is useless. It's useless. If I have a fucking stop sign, okay? If I have a stop sign, which is a control device for drivers, if I take that stop sign and I put it at the bottom of the fucking cliff on a foggy day, okay? And you drive off the fucking cliff, and as you're going down, you see the stop sign. What good is that? You're fucked. You can't stop it. You're done. Indicators are taking what's already happened. You're fucking falling off a cliff. You better stop. You're damn right you better stop. But unfortunately, you're going to stop abruptly, and that ends you. Just like it does in your trading account. Because you're taking mathematically derived information that's been crunched by indicators, okay, and attributing to it a level of faith it does not deserve. It doesn't give you advanced insight. I'm telling you fair value gaps, where they're going to form and inversion fair value gaps before they fucking form, before they're there. The indicator can never do that. It has to have the old data. Then it crunches it. Then it spits it out. I'm ahead of everything. Before any of your volume bullshit, I'm already ahead of it. Before any harmonic fucking pattern, I already see it coming. And what do you think happens when you're a student of mine and you take it serious? You're just like me. You're informed, you're educated, you're fucking light years ahead of everybody else. And when you listen to these asshats, these fucking ankle biters, these little nose-minding pricks, these 20-year-olds that think they know something, they have no idea. They have no fucking idea. And it's entertaining as fuck. And I do this because I want more of it. I want more of it. You entertain me, you fucking assholes. You fucking clowns. I can sit here every fucking day and it's still going to be the same outcome. But you're sitting over there waiting for the day that I'll call one candle wrong. And you'll forget everything else in the live stream. But you'll go to that. And you're still hawking affiliate links. You're still hawking some drama bullshit. Clowns. That's a clown. But I'll have fun with you. You'll be a toy for me. And everybody that learns how to do this will look at people like that the same way. Maybe you won't play around like a cat and mouse like I do. But you look at it and say, you dismiss it. Because it's irrelevant. Their opinion is irrelevant. Because once you adopt your own mindset, your own opinion, because you've handled it, you've worked with the information, you've tested it, you've seen the benefits of it, and it doesn't have any comparison. There's nothing close to it, and there's nothing ever going to be better than it, because this is the market. This is it. Period. Okay? So it's a graduated understanding that my son's going to go through, and he knows it's going to take him some time. And it's not a quick, real fast type thing, because you can't just jump into, well, here, buy the open or below it, and then hold for a close candle. How do you get to the point where you trust that that's even there? You have to have some kind of a logic that has repeated that built on your understanding modularly, one piece at a time. Okay, one little piece at a time, and you get more understanding about yourself, how you're going to endure or fail. And failure is a normal thing initially. Don't be afraid of that, because when you fail in your observations, you highlight these little opportunities for you to say, okay, this is exciting because I thought this was going to work, but now I'm going to find something with more understanding, and it's going to make this so much clearer, and it's probably going to unlock something else that I don't even have a question about yet, and it's going to keep feeding you. It feeds on itself. That's what excited learning feels like. But if you go in thinking that you're going to fail and why bother, and the first time I have any kind of adversity, I'm just going to drop this shit like it's a hot rock. I'm not the guy for you. I want people that are going to be like a pit bull. Bite down on this pork chop and don't fucking let go. Because I promise you're going to eat, and you're going to fucking eat good. Real good. Better than you ever fucking thought. And you'll be able to do it any fucking time you want. You want to take a week off of trading? Wonderful. Do it. Because when you come back, this shit's still going to be working. You want to take the whole summer off? Wonderful. Do it. When you come back in the fall, it's still going to be fucking working. But think about how you think about trading right now and how your educators tell you, oh man, you got to push your edge. No, it's right now. The market's really hot. Man. The market's always fucking hot. It's always hot. It's always moving around. It's always doing these things. Every single week it's moving around. It's always following time. It's always doing the same thing. It's setting up stupid people and knocking them out. What's it doing that for? Liquidity. That's the lifeblood of the marketplace. It's what makes the markets move around. It's moving to where orders are resting. And if someone in here that has a vested interest in pushing price around, just like a casino, they keep people in that lose. And the ones that lose big, they'll give them free fucking rooms. You want to see a show? It's good to have you back. We ain't seen you in a while. Hey, you're down today? Oh, no problem. Don't worry. Here's some tickets. Go watch the Showgirls. Go watch a magic act. Here, we're going to comp you a room. Come back. That fucking room costs them nothing. They want you to come back and spend more money. That's what the market does. They keep selling that idea. Here's a new indicator. Here's a new gimmick. Here's a new methodology of trading. Here's a new guru. Here's a new twist on old things. There's always going to be suckers coming in, folks. That's never going to stop happening. As people grow older, new people grow older, and now they're older in an investment age. And they're going to read the same horseshit that probably got you into trading. And they're going to put money into it. And that one contract, that's all it takes. That one contract above or below old lows, that's liquidity. And they only need one contract to book price. And if you know where they're trading, or no, not trading, but training their eye on taking the market up to a specific level, a la these highs here, or down to the lows, a la these here. What if they can't hide it? Now think about it. They cannot ever hide it from you. That should make you feel confident. It shouldn't give you a sense of overconfidence, but it should give you confidence that this stuff is in your grasp. It just takes a little bit of time of you watching it, studying it, take examples, screenshot it, and see what it did. And you're going to see the things I'm talking about, it repeats every day. That's why the whole moniker is every week, every day, and it won't stop. That's my slogan. That's my little catchphrase. In the beginning, it's like, oh, well, he's just bragging because he got it right. I get it right every fucking week. Every week it's the fucking same show. I get excited and animated because I get to experience it through your eyes. Because I know you've never seen this before. You've never seen it like this. Where it's like, I've read this book before. I know the outcome. That's what it feels like. That's exactly what it feels like. And it's wonderful. It's encouraging. And then you want to teach it to your children when you know it. Because once they have that skill set, that's it. You're done. You're set. You can lay your head down and not have to worry about it no more. That's what I want for all of you. I want it for my son. I want it for his sons and daughters should he choose to have some. But all of you that are listening, eavesdropping in, I want it for you too. You can't even imagine what it feels like to wake up in the morning, whenever you wake up. Not by an alarm clock. Just wake up because your body says, it's time for you to get up and do something, ain't it? And you decide, do you want to make an annual salary by pushing a couple buttons and waiting a little bit of time? Or you just want to take another day off? because it ain't going to bother you if you do. You have no idea what that feels like. You have no idea, but it's all in your grasp by what I'm sharing for free here. I promise you, if it was complicated and you couldn't do it and it was going to require more than what anybody else would be expected to put themselves through, I would be upfront and say, look, you're probably not going to do this. It's going to be hard. Only less than 1% of you are going to be able to do this. I would come out and tell you, I'm blunt about everything. And I would tell you, this is some hard shit, but it's not. What's hard is starting with a systematic approach to studying and sticking with it. Like a diet or working out with weights. You're not getting the results right away. You're deferring the results. You're going to put yourself through this process and defer the results that you hope that you'll get. You don't know if you're going to get because you don't know if you're going to stick with it. And most people don't stick with it. So what do they get? They don't get the results. Hey, I'm trying this diet. I'm trying that diet. I tried this exercise routine. Hey, did you see this new workout routine? Hey, I'm doing the so-and-so split routine. Everybody's got something. How about just lift fucking weights and have a caloric deficit? How about that? It's simple. Well, I just did that same thing with trading. All you're doing is looking at a specific element of time. Start watching at 7 o'clock, up to 9 o'clock. Regardless if you start at 7, 8, or 9, you're waiting. You're waiting for information to be delivered to you in the form of relative equal highs, relative equal lows. And what side of the marketplace are they taking first? That's the trap. That is the gimmick. That's the snare. That's the Judas swing, doing its job, leading the dumbasses, the sheep, that just going to follow the herd. What's the herd? Whatever the market's doing right now. If it's been going up, they're going to buy it. If it's going down, they're going to sell short. That's what a retail-minded trader does. That's what they do. They key up on, okay, this is what's happening right now. What's the easiest thing to do? I need to push a button. I need to do something. Fuck it. It's dropping. I'm going to sell short. And sometimes, it moves continuously for them. And they attribute that as skill, and it's not. They're rewarding poor decision making and gambling. And that's exactly what I did in 1992. And I attributed it as, I'm better than I thought it was. Shit, this was easy. And a couple months went by. Man, I got all this shit figured out. No. No, it wasn't like that at all. Then the market started dropping, having retracements, and I didn't know how to go short. And I was buying it, and every time it went lower, I bought, add more to it. Yeah, I better not put a stop loss on this one. Let me just buy one more because then it only has to go up a little bit more, and then I can get out at even. So see what just happened? I'm not trying to make money. I'm trying to get back something I lost. That's not profiting. That's getting even. And getting even is the same thing as revenge. I want to get even. Fuck that. That's toxic. How do you avoid all that stuff? By knowing what you're doing, what you're looking for, and you've been around the block enough times to know that this is what generally is going to happen. So that means you're desensitized to it. That's what these live streams do. They show you over real price action with somebody that's going to show you 30 years of experience. This is what I see through my eyes. This is what I see. Watch and observe. That's all. That's all you're going to do. And by watching and observing, Caleb is going to say, okay, I see this. I didn't see that, Dad. So he knows now I got to go in and look at when the market does this or that as a result. And I don't know what because I'm not able to read his mind, obviously. He's going to have his own questions, just like you have a large degree of questions, I'm sure, from a session like today. But I want to go into the 15-second chart because I said we were going to do that. But I also want to refer back to this little area here. So when the market was creating this little run, what I was anticipating is that they were going to take this relative equal high out. That's what I wanted to see. Okay. And I felt that we were going to work at least in the lower half of the new week opening gap, which is this is the new week opening gap low, and this is the new week opening gap high. And all of this price action here on a 1 minute chart doesn't look as clear and obvious as it will when we look at the 15-second chart. Actually, that's not what I want to do here. Let's look at if you study the video, what the hell am I doing? There we go. All right. As price creates this price run in here, I've already saw this low, this high, and that low on a 1 minute chart. But like I have the charts over here, like I have a 1 minute chart over here, which is really redundant. That should be a 5. And this should be a 15. When I'm watching price action, I'm looking at a higher time frame chart. And if I'm looking at something on a 5-second chart, a 15-second chart, or a 30-second chart, anything less than 60 seconds, so sub 1 minute, I have to anchor some logic as to what I'm expected to see on the lower time frame. So for a 15-second chart, all of this run from here to here is going to look different. There's going to be some, not always, there's not going to be always a overlap of the same inefficiencies. The same gaps that would exist on a 15-second chart may or may not exist on your 1 minute chart. It certainly isn't going to likely appear on a 5-minute chart. So the price delivery continuum theory is where we have something identified on a higher time frame level. And when I say 1 minute, in deference to a 5-second chart, 1 minute is higher time frame. It's not a significant higher time frame because it's only a 1 minute chart. But if I'm going to engage price action with the basis of a sub 1 minute chart, that means 5-second, 15-second, 30-second chart, 45-second chart, something to that effect. I'm leaning on the logic that the 1 minute chart is subordinate to something higher than it, which would be the 5 and the 15. So if you do all of your study initially with just a 15-minute, 5-minute, and 1 minute chart, you will have a solid understanding of price action. It doesn't mean that you will know when to hold for long-term up days or down days. And it doesn't mean that you're going to hold for the weekly range. It just gives you opportunity to practice and study where and how price delivers. And the relationship between a 15-minute time frame, how it books price, and then what it looks like on a 5-minute chart and how it books price, and then a 1 minute chart. But when you go down to a 15-second chart or anything less than a 1 minute chart, you're going to see spotty price action that is many times acceptable in that time frame. But when you start seeing things that agree with, say, a 1 minute chart here, then it's going to be a matter of, well, let me do this. 1 minute chart. Bear with me 1 second. You should be seeing the 1 minute chart with the opening range gap. It's shaded here, but it's the portion, the lower half portion here of the new week opening gap. So the new week opening gap high, new week opening gap low. If we measured that like this, and I'm just going to eyeball it, okay, to 604 even. See that right there? That's the lowest quadrant level, okay? It can trade to the midpoint, but what's a low-hanging, low threshold objective if you're going to target something going long? The lower quadrant, right? Or the low. Okay, great. So if I think that I'm looking at a marketplace that's trading off of this breaker, low, lower low, high, that's not a breaker. That's a breaker to me. This retracement, every retracement that sees it break to the upside, that's a breaker. Inside of here, in this range, that last up close candle, what is that? That's a bullish breaker. We're trading down into it, and then we have a shift in market structure right there. I want to see when this gap formed on a 15-second chart. All these boxes here are relative to a 15-second chart. You'll see it in a second. But I want you to look at the logic on a 1-minute chart. Shift in market structure on that candle right there. Then we have the candle close here. So now on this time frame, we would have this. Big paradigm shift about to take place for you. You would see that gap. And this is institutional orderflow entry drill right there if you were trading on the 1-minute chart. Because you don't want to see this gap fill in. This smaller gap that's different shade of color, that is inside of that gap because it's a 15-second buy side and balance, sell side inefficiency that you want to see what? Stay open. Stay open. Then you want to see it displace higher, proving that this is going to stay open. And then we have what? This rejection block is pierced right there. So then on the lower time frame, 15-second chart, we will drop down to that. When it trades into this gap that will be based on a 15-second chart, and it's also, what is it? What's this? On a 1-minute chart, what is this? That right there. It's a wick. Half that wick because it's treated like a gap. If we measure that, half of that is this. So when I'm watching price action, I don't just look at one time frame. I have a continuum of price from a weekly to a daily to a 4-hour to 3-hour, 2-hour, 1 hour, 30-minute, 15-minute, 5-minute, 4, 3, 2, 1, sub-minute on a matrix chart where it's a lot of the 5, 4, 3, 2, 1 and sub 1-minute chart time frames I watch. And I'm reading price action like this because that's exactly what the algorithm's doing. It's cycling down and then going right back up, cycling down and right back up through the time frames. So if I know I'm in an area where the 1 minute is in a buy program, if it's going to go up, where's it going to go to? New week opening gap low, because it's going to gravitate towards these new week opening gaps. It's this week's new week opening gap. It's a highly influential price action. It's like or not price action. It's a PD array in price action. It's like a black hole. It's not going to escape it. It's going to draw it back in. Well, we're down here waiting for it to prove that it wants to go up. Wonderful. I don't need to be a buyer down here when it's sloppy and who the hell knows what it's going to do. I don't need to buy this institutional order flow entry drill on the 1-minute chart. I want something that is in line after it's occurred. It's done this movement here. And then I have this wick on the 1-minute chart. That means that when we opened up here and create that separation, let me take this off for a second. That separation between that wick's high and that candle's close. Wonderful. The next candle we open up here. And does what? It trades down. There is no gap right here on the 1-minute chart, but there is a consequent encroachment midpoint of that gap on that wick because wicks are gaps. That's the logic I teach you to have. So when we see it drop down like this in the recording I put on YouTube, you can see I executed in a market order. As it went into that, I hit it market. Rallied. And then it showed this imbalance here. Trades into that. And then delivers up into the new week opening gap. Because I'm trading pre-session, that means even before 7 o'clock, I'm using the logic of relative equal highs over here. So now watch what occurs. In price, are these relative equal highs hiding from you? Were they in your chart too? Of course they were. Were you watching chart at the time? Maybe, maybe not. I don't know. But I know that there's liquidity up there. In this 2024 mentorship, I taught you to validate a relative equal high. It is a high that has a slightly lower high to the right of it. That's a valid relative equal high. That is where your liquidity is most likely going to be tapped. Can it run relative equal highs that have a slightly higher high than that one? Sure can. The key is, and this is the part where you write down shit, if you watch that one that has a higher high, if it makes the higher high with a wick, but the bodies are still showing this body close is slightly lower than that one. If the one that you think is a relative equal high, if it wicks above it, but the bodies still stay below than the one to the left, that's still a valid relative equal high. And it'll go into the wick. You're just going to be met with the challenge of you need to see it trade above and close and show speed and magnitude above. If it has a wick, it's consequent encroachment. Okay. Remember what we were looking at when price was diving down today below its initial low after 930's opening? I said, watch the wicks. That's why you need to see, does it want to indicate that it wants to go through that? If it does, then you probably are part of a more meaningful run. Or if it does that, give it a chance to reverse and get back above it, which is what we outlined this morning, and then trade to the opening range gap again and to the buy side liquidity I outlined at the very beginning of the stream. See how all this stuff goes together? It's logic that will repeat for you. But until you see it and expose yourself to it via live stream, watching it over real-time price action. Because if I don't know what I'm talking about, you're going to see it. It will fail miserably. The things won't be there. Are you seeing that? Or are you seeing shit that just does not make sense otherwise, but works? Yeah, it's like technical science. So this is the draw on liquidity. Are you having fun? I'm having fun. All right, so your buy stops are here. So that's where your buy side liquidity is. This is the entry. I'll show you that in a minute. It rallies, creates an imbalance here. Notice that this imbalance doesn't even match on the 1 minute chart. But we're watching it on the lower time frames. But again, what is here? When price goes above it, do we just disregard this? Well, if you're watching anything else but ICT, yeah, that's exactly what you do. No, we don't do that. We take and you measure it on the time frame it exists. So there is what? Consequent encroachment. Do these candles touch that consequent encroachment? No. So while I'm watching price action, I may be showing you the execution being recorded on that one specific time frame. What am I not showing you? It's my observations through the price delivery continuum. It's watching higher time frames down to lower time frames, and I'm weighing out, do my PD arrays keep price from dropping, or if I'm expecting this consequent encroachment to trade to, which is reasonable, it's consequential. It's consequential to you holding on to the trade. So it can encroach into the mid part of that wick. Hence the name, consequent encroachment. So if I'm looking at it and it doesn't touch the midpoint of that, if I'm bullish and if I'm in a long trade, does that bolster my confidence or does it chip away at my confidence about holding the trade? If it fails to touch that midpoint, is that a good thing or is it a bad thing for my trade if I'm long and I'm trying to make a gain by having prices move higher? It's fucking wonderfully delicious. That's exactly what I want to see happen. But you aren't taught that in anything else. This is real order flow. I didn't have to show you a market profile, volume. I didn't have to show you depth of market, a ladder, no VWAP. Fuck all the Mickey Mouse bullshit. You're literally seeing everything in the open, high, low, closed bars. Okay, everything is in price. Everything. They're never, ever, 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 ever gonna be able to hide it from you. It's never gonna be hidden from you. They cannot fucking hide it from you. Stop worrying about it. It's going to not work because I'm going to start doing it. It's going to stop working. They're going to change the algorithm. I'm not changing shit. Well, part of this I want you to understand. It's going to keep fucking working, man. Come on. But you're watching time frames that are higher down to the lower time frames. You're going to see things on the lower time frames that you won't see on the higher time frame, for instance, the 15-second chart. But I'm managing the expectation of what the 5 minutes doing, what the 15 minutes doing, and how many things are forming on that 15-minute chart. It's not forming like on a 15-second chart. And it's behind you after it forms. That means the price is advanced. If you're on the right side, you're moving further away from that thing that occurred on the 15-minute time frame. For instance, say this gap down here was based on a 15-minute time frame, and we're trading here. Is this all that influential in terms of watching price action at that moment there? No. So as I move away from the higher time frame PD arrays, that's supporting my confidence that the trade's panning out. I don't need to worry about the 15-second anymore. My focus drops down to the 5. And as long as I'm moving away from the PD arrays that's formed on the 5-minute chart, then that's wonderful. That's exactly what I want to see happen. But I'm watching that 1-minute chart. And then same thing, because 1 minute's going to be closest to anything less than a 1-minute chart. So the PD arrays that form on the 1-minute chart, if I'm working with a 15-second, 30-second, 45-second, or a 5-second chart, I am very, very hawkish over the 1-minute chart. I'm watching every PD array. This is an example. So if I have a wick here, the midpoint of that wick, I'm watching as it's doing this. I can see it touch that, but I don't want to see it touch it. When's the last time you were in a trade and you know what you're looking for support or resistance? And think about it, it goes in the face of trading support and resistance. You want to see price find support at support, right? I want to see it come down, touch this, and push price higher. Well, that right there is flawed logic because support ain't pushing shit. But the narrative that causes you to lose money and put false hope in something that doesn't work. I want to see a level that could support but not touch it. That right there is a whole paradigm shift. If something is reasonable to assume that this is likely to happen in price, but it can't even do it, it tells you without a shadow of doubt, it's immediate feedback. This motherfucker's going up or going down in deference if it can't trade up to a level that you thought it could be, if it could be touched. Think about it. Never thought about it like that, have you? Right, because I take everything and turn it upside down. And when you do that with trading, it works. If you do what everybody else does, you're going to get the same results. 90% of people lose money. 90% people fucking blow their accounts up. 90% of people can't be profitable long term. They don't see what price is going to do. They can't trade. They can't do this, can't do that. They don't know when to buy. They don't know when to sell. You can't time the market. That's what they tell you. You can't time the market. What the fuck am I doing here? I'm literally telling you in advance what it's going to do. On a 1-minute candle, on a 15-second candle, why it should do it. You have a choice. You either believe the guy that's standing here telling you and proving it to you and charging nothing for it, or you believe everybody else. What are you going to do? You have a choice now. What direction are you going to walk forward with? You're going to believe the guy that's proven it to you and saying, all you have to do is keep taking lessons and you're going to learn more as you go. And it costs nothing out of your pocket. You're going to grow and you eventually will make more than you've ever fucking made in your job. Ever. And what you do beyond that is up to you. Or you want to listen to everybody else's opinion. I don't know. You tell me which one's the best, wiser decision. But that right there sets up the tone for it to run higher. How high can it run? Well, the draw is the new week opening gap low, right? No, because that's equivalent to and below the relative equal highs. That's over here where the stops are. This is where real orders are. Anyone that's been short, they have stop orders right there. How do you protect a short stop? I'm sorry, a short position. You put a buy stop on it. So if it goes up to that level, you want to be out because it could keep going higher. You don't want to hold on to unlimited risk, right? So above highs or a singular high after the market's dropped, you don't need a book map to tell you that there's buy stops above that. You don't need that. Do you need it in the beginning to help convey and teach you conceptually? I believe at the time when I first started, if there was a way that I could see real orders, that would have helped me understand why the market could gyrate to a specific level, but not to everything. And the perfect excuse of saying why it's not always the be-all, end-all panacea that people say it is, just look at the live streamers that use it. Why aren't they talking about the very levels that call the high and intermediate term high and low in the day? They're not, because they don't know how to read it. It might be telling you that, that there's this number of trades sitting here in a pending order. But that number of trades, pending above an old high or relative equal highs, or below a low or below relative equal lows, doesn't mean it's going to turn the market. It doesn't mean anything except for that's where the orders are. So if that's all you're going to get from it, I've already taught you how to read price action where you don't need any extra gimmick. Everything is in the chart. Everything is in the chart. As long as you have real-time data, you have every weapon that's available to you that's required to do well. So you can't use the new week opening gap low, which is that big bold line here from this week's Sunday's opening. You can't use that one because the barrier to getting to the liquidity is above that here by that candlestick's high. So right away we're met with, this is the initial interest. Can it trade there? And then if you start doing calculations, which you don't see me doing, but I'm showing you why I did it, and you're going to see right away this is exactly what I was doing. On my other chart, because I have monitors in front of me, and you can see that if you go on my YouTube shorts, you'll see my trading layout. I have 12 monitors. I have a 13th monitor that I don't have actually hung up. And I was telling my kids the other day, I got to get this thing hung up. It's a larger screen. But do you need all that stuff? No. And I probably shouldn't have said it that way because it sounds like, oh man, I'm not going to be able to trade like this or have this information unless you don't need that. You can do it with a 3-panel layout like I first started. But I had to preface this part of the discussion with the disclaimer again because I don't want you believing just because I said it. I want you to investigate it yourself. See it if it's there, if it's not. Like anything else, okay? For the people that go through it and start trying to study it this way, it's going to unlock a perception of price actions you've never seen before. Everybody has a 15-minute time frame. Everybody has a 5-minute. Everybody has a 1-minute. But how they manage it, the continuum of how price is delivered through that mechanism of higher time frame down to lower time frame and then back up. Not just one side. It's got to go back both ways. And you're constantly weighing out what feedback you're getting with the PD arrays I teach. And when you can see the price action doing these elements and how it supports price continuously moving, it's not being negated. It's not eating into levels that would otherwise be problematic. Everything's supporting each other, but it's not support and resistance. It's not supply and demand. It's literally looking at how price refers to liquidity and inefficiency in the spectrum of moving in a predetermined level above these relative equal highs. Okay, but now how far? The question is always this: where is price drawing to? Well, where's the relative equal highs and relative equal lows? Once you determine that, how far beyond them can it reach? Well, what NDOG or new week opening gap is existing beyond them, because that's where it's going to gravitate to. So we have the buy side here, these relative equal highs at the butt end and into the lower quadrant of the new week opening gap, which is defined by that high here, this line, and this line. If you watch the beginning of the recording, I show you where these levels are anchored to. It's Sunday and Mondays. I'm sorry, Sunday's opening tick at 6 p.m. and where Friday's settlement price was, and the difference between it. Whichever is higher, that makes the new week opening gap high. Whichever is lower, last Friday's settlement price or Sunday's opening price is obviously the low. Okay, so that's how you define it. But the midpoint of it is here. That would be consequent encroachment. But because I want to have the lowest threshold exit, I want to show my students how to do that. I want to show my son how to do that. Yeah, it could trade there. But what's before that? The lower quadrant level right there. So to get this price, it's going to have to book what? 19,610.50 or slightly higher, right? Right? Of course. So if that's the case, we're going to have these levels here. And just know that line, once we get above the blue line, which is the buy side liquidity here, if we have that on our chart, we can do this. We can look at a 15-second chart here. All of the things that are over here on this chart, right here, are being shown to you on a 1-minute chart, and I'm watching on a 15-second chart. Now, 15-second chart, your first time seeing it, you're going to think, wow, it's too fast. I can't use that time frame. It's too fast. It's not moving any faster than what that 1 minute and the 15-minute time frame, the hourly chart, the daily chart. If you're watching ticking price on a 15-second chart, have a daily candle chart right next to it, and you'll see it's not moving any faster. But because you're looking at the candlesticks forming, closing, creating another one, open, forming, closing, it feels fast. But when you anchor it to a higher time frame reference point, like for instance the 1 minute chart, the 1 minute chart is my guide on what I'm doing for a 45-second chart, a 30-second chart, a 15-second chart, and a 5-second chart. I've executed, and you've seen me do this with a 5-second chart, and it has the same measure of precision that I show on any other time frame. So if I'm looking on a 1 minute chart like this, and I'm expecting price to gravitate up to that 19,610.25 level, which is right here as well on the 15-second chart. It could trade up to the halfway point of the new week opening gap, which is here, over here, okay? But I want to be able to teach my son how to get very easy objectives where it's not hard work. It's more likely to fill this one than try to reach for something that's really high and lofty, because I've been in a pursuit of perfection my entire career. And every time I demand perfection while I'm moving in the right direction, because of the aspect of the limit order meeting the spread in that agreement before I get my fill, sometimes I don't get my exit, even though the price can book there. And I've shown this in live streams. I've shown it in live examples. I've shown it with live accounts. I've done it. And it trades to the price I've called. It trades to the limit order price that should have booked, but it doesn't trip me in. That I take that as a little aggravating, but it's also a pat on the back for saying, you know what, you're a fucking animal, ICT, because literally you called the very turning point and they were being dicks on the way out the door. They said, no, you can't have it, you motherfucker. You're taking everything from us and we can't let you have it. Don't take the last piece of pie. So I have afforded myself a strategy that says, yes, I can see where the best turning points are likely to form, but on a steady diet, I need to know where the easiest barriers to profitable exits are going to be for me. Which is the easiest thing to get to? Well, it can't be the low, because that's where the actual relative equal highs are, where the buy side is, and it's just slightly above that. So that's that blue line, remember? And then above that, we have the lower quadrant of the new week opening gap. And then we have the midpoint of it. So this level here is the easiest threshold to exit profitably, even if I can't get the midpoint of the new week opening gap. So you see how I'm measuring with logic that it could go to a specific level that I can forecast, I can see it, and I can feel good in my journal and say, I felt really strong about the consequent encroachment of that level being traded to. But rules state that to have a low barrier to exit profitably, state that what's the threshold prior to that one? Well, it would be the lower quadrant of the new week opening gap. And then as price created this level here that's green, I'm looking for that to be a breakaway. And it acted as such. It didn't even trade back down into it. And then we had this gap here from where we closed here. We opened on that candlestick right there. And there's an actual gap with an order block. This is a strong PD array. If you ever have an actual gap where there's no wicks and you see it after a down close candle and you're bullish, as soon as it trades down into that, that's a buy. And that's why I bought it. But it's the gap. Even if that order block wasn't there, this would have been a fair value gap. And that's what's highlighted there in blue. So it's for students that know more than you generally do as a new student watching me on YouTube. I've had students for a number of years following me. And they have a little bit advantage of having been with me longer, and they know a little bit more about what it is I teach. But most of it's actually on this YouTube channel. So don't look at them and say, well, I wish I would have been. Just watch the fucking videos. They're here for free. But as it slammed into that, I went long, entered at the market. You watched it in the recording. And then we rallied up. In this area right here, right there, that's this wick. That's what's being measured on a 1 minute chart. I'm watching as price is going up, I'm watching the 15-second destroy the midpoint of that right there, which is exactly what I want to see. And then when we start to come back down in, I don't want to see it touched. Does it touch it there? No. Oh no, oh no, oh no. I want to see it come down here and not touch it. Does it touch it? No. Then it starts to rally up. Wonderful. Institutional order flow entry drill. Why? Because we have proof that it doesn't want to go down consequent encroachment here based on a 1 minute chart. See what I'm doing? I'm measuring the strength and the magnitude that's still possible in the delivery of the price, but I'm measuring the underlying strength and seeing, does this really prove that I'm on the right side? And is the market breadth in a visual representation that can never hide it from you, is it supporting higher prices? Yes, because if it was weak and touched this level here, then it's probably going to have a deeper retracement on me. I don't want to see that. I want to be a part of a trade. I want to hold on to a trade. I want to fucking add to trades that show me all these types of signatures that tell me, no, I can't even get down there for you, ICT. Yeah, this is your shit, but I can't even get down there for you. I can't even get down. Okay, that means you're getting ready to go up for me, and I'm already on side. So I'm going to be comfortable. I'm going to be wonderful, and then I'm going to make my target better. When it was just above that blue line, watch the recording. I raise it up to some random level that you can't see otherwise, but it's the lower quadrant. There's the buy as it happened in real time. Look at the little caret that appears right at the order block. Look at that. You see that? Beautiful, isn't it? That's the entry. Could you improve on that ICT? I probably could have by a tick. That's the best I probably could have improved on because I was doing it with a market. Limit order, I probably could have done consequent encroachment, but risk maybe not getting filled. But that is fucking poetry. Like, that's beautiful. Like, that's beautiful. The market rallies up, comes back down, doesn't give me consequent encroachment touch there. Folks, this is fucking beyond charter level. Charter level members never even learned this shit. They never were going to get these lessons. They never, ever, ever, ever would have gotten this lesson. Ever. They never would have gotten it. They never would have learned this. It's never been taught anywhere else before. It's never intended to be in the public size. It never was supposed to be in your hands. And you're watching this stuff. You might be thinking, this is complicated. Or this is dumb. I don't get this. The logic was used to take the trade. And you're going to hear me bloviate about the same stuff every single time we're in front of live streams. This is what you're looking for. You're watching this, Caleb. You're looking for this. And you're going to see this shit just keeps happening over and over and over again. And it might seem alien to you. It might seem complex to you right now. But you're going to see it doesn't get complex. It gets easier because you keep seeing me say the same things about the same stuff. All you have to do is know where the price is going to move. Where is it going to draw? Relative equal highs. Okay. How far past the relative equal highs? Well, is there a new day opening gap or is there a new week opening gap just above it? Where is it close proximity? Use that one. If the range permits it, break that range or inefficiency into quadrants. Lowest quadrant right here. What's that price right there? 19,610.25. To get that price, you got to book what? One tick above it. Bam. Look real close right here. You'll see the little arrow where I'll get out at. Bam, right there. That's the logic, folks. So am I making this shit up as I go along and it just happens to fucking line up to the things I'm teaching? That's the other shit I get in my comment section. Oh, this is after the fact. He's just trying to make it fit. He's just cherry picking. Are you out of your fucking mind? Here's what I'm doing. I'm cherry picking everything that fucking works live right in front of you. Woo! How about that one? Yeah, of course I'm fucking cherry picking. I know which fair value gap I want. That's the one I want. The one I called to you live and told you it was going to be institutional order flow entry drill. And it delivered like a fucking gangbuster. Bang, delivered. I don't run out of fucking luck and I don't run out of fucking yeast. This baker can make fucking cakes forever. As long as the Lord gives me breath and faculties I can still have in my head, I'm going to be doing this. It's not going to stop working. So you might as well just warm up to the idea that, hey, this is the real shit. I'm going to try to learn how to do this. Even if you're just 1% better each week, you're moving in the right direction. And don't let go of it. Keep progressing further and further in the future. You'll see it works. It fucking works. So now let's slide on over into the 930. And this is probably going to be the last long one in the series because I have to make it palatable for Caleb because it is a lot. I'm going to take these. These are just measuring those wicks on the 1 minute chart, and I don't need this, and I don't need the old lows. I'm sorry, the relative equalities. We don't need to see that anymore, and we don't need. And we'll keep that one for now. All right, so 930. Okay, so we ran up into the opening range gap, went above it a little bit, broke down. Here's a gap right there. You see that? Right there. We overshoot it a little bit. That's equivalent to a 1 minute mohawk. Just a little bit of a coloring outside the range. You have to keep things in perspective because this is a 15-second chart, meaning every single individual candlestick is representing the open, the highest high, the lowest low, and where we stop trading every 15 seconds. Now it sounds scary, like, man, this is moving too fast. It's moving no faster than it's moving on an hourly chart, a weekly chart, a monthly chart, a yearly chart. It's not moving any faster. The only thing that tricks you by perspective is the frequency of a new candle forming. The range upon which it's moving, higher and lower, it's not changing that. The same amount of time and fluctuation is occurring. So when people say the speed is too fast, they're really talking out of their ass because the market's still doing the same speed. What's changing is the magnitude of the move. That is not determined by the time frame you're watching. That has no direct influence of how far it's going to go. Something occurring on a 15-second chart doesn't equate to or make a 100 pip or 100 handle run in price. You can't think about it like that. The market's going to run like that because of time. If it's the right time for those types of runs to occur, then it will. It matters not whether you're perceiving price through a 15-second chart, a 1 minute chart, 5 minute chart, 15-second chart, whatever time frame you're watching. The magnitude or the distance upon which price is going to move is dictated by the time upon which that move begins. And it doesn't mean that you begin a move on a 15-second chart. 15-second charts just gives you these areas of opportunity for you engaging price. It does not make the move faster, and it doesn't slow the move down. It just gives you opportunities to engage what's going to be in play. Higher prices or lower prices, okay? So we're going to go into the second drop where we're spending too much time in the opening range. We're inside this inefficiency here. We drop down after working the midpoint of it, or not the midpoint of it, the lower quadrant. We drop, institutional orderflow entry drill there. Almost an immediate rebalance right there. If I was watching this live as it was going up like that, I would have commented, said, watch for an immediate rebalance. Immediate rebalance is when you have a big down close candle and the next candle opens up and goes right back up to the previous candle before the down close or the larger range candle. And when it touches that right there, that's one of the best on-side indicators that you could ever get in trading. And when you're watching time frames and you're watching and managing your trade, any instance of that occurring and you have not had liquidity taken, it didn't happen yet until that right there. See that? So it could have very easily went up and touched that candle's low. And if it did, that would be an area where I would pyramid. If I was short, I would pyramid there. And I would look for this low to show speed through it. It does. And that would be first partial. But let's go to the conversation about what I outlined real time on the live stream. You watch me execute on something beforehand, and I get the flack all the time. Why can't you talk about these moves in real time, ICT? You're a bitch. You're a fraud. Well, when I do it, you don't pay attention to it. You want me to execute and place my stop loss so you can mimic me. I don't want you doing that. But I will do it here. I have to do it because I want my son to do it. So we have this area. I'm going to take this box and then that shaded blue area. Remember I was telling you that's the range between the opening price to the lowest low of the day. So now it's gone. And now that chart looks familiar again. Okay. So we went down below the lows over here. This is a 1 minute chart on the left. Low and a slightly lower low to the left of that there. So we went down below this low right there. This price action right there is this price action right here. Watch. See how I'm making that little box here on the 1 minute chart? It shows it here on the 15-second chart. So the market has a shift in market structure on the 15-second chart here. The same thing you see on this 1 minute candle. It rallies up. This is a breaker. This is a breaker. This breaker, this up close candle, extend that in time there. So you have a gap, which is a buy side imbalance, sell side inefficiency. And you have the midpoint of that gap, which is consequent encroachment, and then you have the breaker. So you have several things there. If you were watching a 15-second chart, or if I was trading on a 15-second chart, I would have tested the market by entering in here. Would it feed that idea? It rallies up, and it does. Then we said we want to watch it trade back down into the new day opening gap high, and maybe as low as the new day opening gap low on the 16th. Go back and listen to the early part of this stream. You'll hear me saying those things over live price action before it happened. Later on in the stream, I explained why, because the velocity was over here with this. The bodies were respecting the new day opening gap high, and it didn't do it here. So which low am I going to refer to as a discount array for price? This one. Even though this is lower, I don't care about that. I want this one. Why? Because this one was respecting the same reference point I'm using to enter off of over here on a 1 minute chart. We want to see it open, trade down to that new day opening gap on the 16th. We get that here. Trades down, hit it, and then rallies up. Then we have displacement. We have a separation of overlapping candles, which is what we're seeing in here. All of these candles are overlapping. They're sharing the same price range. The highest high and the lowest low. They keep pricing them back and forth. And then we leave it right there. Wonderful. That's this movement right there on that candle on the 1 minute chart. That's what I said when this candle was still active on the 1 minute chart, lower left hand corner. When the candle I'm highlighting right there was still forming, had not closed yet, I said we're going to see a fair value gap, and I would like to see it create an institutional order flow entry drill. That means go one tick below this candle's low, and then rally up to new week opening gap low, and then we'll see what it does after that. Well, we get that here. Boom, boom, rallies. See that? This, we don't want to see that close back in. Why? Because we're close to a target. And if it's going to go here, it's probably going to run this high. Because there's stops right before this drop down here. Anyone short, where's it going to place their protected buy stop at? Right above this high. So if it's going to go here and trade into this old opening gap, which is shaded in pink, that's the difference between yesterday's settlement price and where we started trading at 9:30. That's the opening range gap. Price eventually trades up into there and hits the new week opening gap high. Look at the bodies. Look at the bodies respecting that on a 15-second chart. Buying and selling pressure causes that, right? Buying and selling pressure causes that much of respect of a level that's supposed to be randomly pulled out of my own ass. No, come on, man. At some point, you're just going to have to say this is something to this, and it's not somewhere else in books. No other teacher, no other author talked about it. Then you have this inefficiency down here, and go over to the left. See that? So this singular candle and this singular candle here are sharing space, the same space, the same range. And it passed through with one single candle on the downside here and on the upside here. Go back and listen to the time when we were trading here. We can see it drop down below the new week opening gap low and trade into the inefficiency right here, but this is a balanced price range because we passed through it here and we passed through it here. So between this candle's low and that candle's high, that little box is balanced. It's like a brick fucking wall. It's like, you will not pass me. Why? Because it's in a buy program. It's going to be reaching for the liquidity. Here, and where we mentioned earlier, where the buy side was eventually, we saw it traded to. But the point was, I can see this. I'm watching this, and I'm pairing this up with this over here. So just as much as this is a balanced price range, this candle in the lower left-hand corner, that candlestick's high, and that candlestick's low. Those 2 price points define where 2 candles back to back have traded in both directions, passed through multiple times in that range. So think about like a trading range. Okay, you've ever studied the trading range in a market? It's most traders are doing what? They're waiting for the breakout. Okay, and I'm not a breakout trader, but I can understand that when a market passes back and forth through a predefined range, high and low, it's going to take something significant to go on the other side of it. So if I can see those types of signatures in price action, it's 2 forms of it. Single delivery down here, 1 candle, and I mean it like this. Look at it like this. Conceptually, view it like this. Gap. Well, now we passed through it. So we offered what here? Buy side. What's missing over here? Buy side, because they only have 1 single candle going down. So in a perfect world, a balanced market, a efficiently delivered market would have the range open all the way up to here and pass back through it. Because only this single candle for 15 seconds only passed through the range of the previous candle's low to the candle's high here. So between those 2 price points that's shaded in this blue, it only offered movement going to the downside. How many times could someone buy or sell in that 15 seconds? Not much. So what's it inefficient? It's inefficient in the scope of price moving up doing that same price range, and we get it here. Okay, so because we have 1 single pass on this candle and this candle here, I see that visually as a balanced price range. It's offered both sides. It's true because we have not seen what? The buy side that was going to be targeted, which is the 638.75 level. What does the market do? It trades down, watch the bodies. The wicks can do what? Do the damage. They can trade outside the range. So I'm looking at this as a balanced price range, but I'm anchoring it to what logic on the 1 minute here. So the bottom of that candlestick right there. Go back and listen to the stream. I'm telling you about this. I'm not referring to the 15-second, but I'm anchoring it to the 1 minute chart. As I'm referring to this candlestick here and this candlestick, that's a balanced price range. But it looks visually like this on a 15-second chart. So there's more room for it to have this little errant price action there, but it's not errant on this time frame. Because watch. We're inside that balanced price range. It did not take out that candle's low. That's reasonable. It's like a brick wall. You're not going to go past me. Past what? The low of that range that's defined by that candle. Find that logic in a trading book. It's not there. It's not there. I had to come up with a way to describe something that I still can't go beyond the scope of what I'm saying here. That's really occurring right there. But because it happens to visually agree with the primary function of what's occurring at that time, it allows me to communicate to you visually. Balanced price ranges are an efficient delivery mechanism. But if they ever fail, that's a huge, huge indication that something has changed, and it's manual intervention. Because algorithmically, the price is going to respect these types of things. But if they stop, the hand's in the mix. The hand is the market maker. The people that are going to push price beyond where you think they're going to go, even my stuff, even me taking a trade, it's not going to work. They're just going to upset it. And that's okay. I can accept that. Problem is, can you? Can you accept an uncertainty of when that's going to occur? I got things that I can see when they get involved in it, but not always. But when I see things like a balanced price range give way, then there's something underlyingly behind the scenes that I don't know what they're doing, but I know now they're in it. Remember the analogy I gave you when Neo in the book, or not the book, the movie The Matrix, and he sees that black cat walk, and then he looks over and sees it again, and he says, well, that's weird. That's deja vu. I just saw the same cat twice. And they all knew because of experience, shit's changing. We got to go. The agents are on our way, or on their way. There's a change in the Matrix. They made a change. That's manual intervention. The same thing when I'm watching price visually, and I see things like a balanced price range break. What I think was underway is changed. It's not likely to occur. Here, that's not the case. We're seeing this candle's high, that candle's low because it's moved back and forth. In that range, we're not concerned about price going below that. We're seeing it deliver. Up, down, up, down, up. You see it? That's the balanced price range here on the 15-second chart. But visually, it's this. This candle's high, that candle's low. But that it's occurring right there. Did that candlestick go below that low right there? No, it didn't. So what's changed? Nothing. Everything's still valid. That's why I was telling you. I believe we're going to go down to this little area here in the inefficiency on the 1-minute chart, but not go below this area here because this is a balanced price range. This range high, that range low. Listen, go back and watch the recording. It's there. This is the part when people watch these portions of it, it sounds like, oh, he's making up shit. I get so tired of saying this shit that if you just listen, I'm telling you this stuff before it happens. Now I'm explaining in ad nauseum the details as to why it's doing what it's doing, what it looks like, how to recognize it. Remember pattern recognition? When you're hunting something, you have to know how to track it. This is what a track of this balanced price range looks like. And you can see it going back down into that balanced price range, but not going past it. It says, no, you're not going lower than that. So any retracement down like there, that's not changing anything. It's breaking the hearts of anybody that, may be trading against it. Maybe they're long up here. They chased it, and it's dropping down here, and now they're scared. Like, oh, it's going to keep dropping. No. The market rallies back up, finds some support at the new week opening, got low again, and then here. And I was telling you, watch. Look what it's doing here. During the live stream, see how it's finding support right at the middle of the opening range gap? That's what this is. Okay, the opening range gap. I'm going to take that off. When you take this stuff off like this, it's like, what is it doing? It's hard to discern what it is it's trying to do. And if you start looking for indicators to give you clues, if you start looking at harmonic patterns and things or retail patterns, you're placing your faith on something that doesn't mean shit. But when you start looking at what the algorithm will refer to, that's what I'm pointing you to. I'm pointing to the very reference points, and I'm proving it live. These are what the reference points that the algorithm is going to refer back to. And it's going to behave based on this. Nothing else. And then what does price do? Everything that he fucking says. And for people that don't want to see me do this and they want to watch me fail in front of you, it kills them. They punch the fucking air. It makes them mad. And I love it. Cry harder, bitch. And the market rallies up. Comes back down. Small little retracement. This is the old relative equal high, which is now, as it retraces, is what? It is a discount array. So old highs is the highest form of a premium array. Old lows are the, I said that wrong, I'm sorry. Old highs are the lowest discount array. It sounds like an oxymoron. How can an old high be? Because if you're above it and trading back down, think in this regard, think classic support and resistance. Old highs are the highest discount array. Old lows are the lowest premium array. So if you have a reference of where the market's going to draw to, up or down, every time you breach a PD array, you got to look back at the range it just traveled through and map out each PD array. Did you miss a PD array not being traded to? Did it totally disregard it? That's a good thing. That's a good thing. That means you're on side. All those things are indicative that you're on the right side of the marketplace. So to answer the question in continuity, and what I was referring to last Friday when I was saying, when people are asking me, how do you hold on to trades? How do you trust trading and catching big moves? Well, I talked a lot about that. I did a clinic on it today. In the market trades back down in relative equal lows, sweeps it, doesn't touch the new week opening gap here, high. And now we're just meandering around. And this is a 15-second chart. Breaks down. Where's the trade back into? New week opening gap high. What time of day is this? We're in lunch. So what can the lunch market time do? Retrace on what's been profitable. So it goes back against what was been underway in terms of higher prices or lower prices. So it's going to seek the sell stops on moves that's been going up, or it's going to seek the buy stops on moves that's been going lower. Look at the reaction off of that and where we're at here. I mean, if if you don't extend the new week opening gaps on your chart and keep them on there for a few weeks, you're trading blind. Like you have no idea why the market's doing what it's doing. And if your indicator or if your idea of your elbow, last time you had tennis elbow, the market went up, whatever the bullshit logic is that you use, whatever it is, if it agrees with my stuff, your stuff's going to work then. And you can say that's arrogant or not, but that's the fucking truth. That's what makes your stuff work. When it happened to be in those fleeting moments where it's in agreement with what I say the market's going to do. And then there you go. Now imagine you have done the due diligence of studying and price reading like we're doing, tape reading and defining certain things, getting familiar with certain logic. When you sign up to learn a language, like I went through Spanish 1 and Spanish 2, and I know a little bit of Arabic. I know a little bit of Spanish. That's pretty much it. Those are the two languages that I learned from. And when I was working for an Arabic family, I learned all the bad words first, obviously, because I want to know when they're cussing me out behind my back. And then I learned the casual stuff. And when you sit down with me and you want to learn how to read price action, and you want to be able to read price action and do the executions like you watch me do, and you want to see me share this logic in a way that's straightforward, easy, real fast. I want you to think about, say you're foreign and you want to learn to speak English. And a lot of my students actually chose to learn how to speak English because of wanting to learn from me this. And now they can speak English because they have been so inspired to learn how to trade. They force themselves to learn English so that way they can listen to me. Did that come easy? No way. When you learn another language, it takes time. And it's very difficult. And especially the English language, because we have words that shouldn't sound like other words that's spelled completely different. Like wood, W-O-O-D. And then you have W-O-U-L-D. What? Yeah, it's very confusing. And if you have time, you can look on YouTube. Look at Gallagher. He's a very funny comedian, and he's very popular for taking this as a skit idea and makes fun of our English language. And it's like, who the hell designed this? This is dumb. But it really is true. I'm thankful that I had learned English initially, because I think I would have been treating it like I did when I was trying to learn French, or I tried to learn Chinese, and that's a really hard language. I tried to write and read Arabic. That's very hard too. It's beautiful to read. Like I love the way it looks. It's beautiful. But it was hard enough just to learn to speak a little bit of it. And I'm not that fluid with it, but I can get myself through a little bit of a conversation. But learning a language like this is not going to be easy. It's not going to be right away type results. Okay, it's going to take time. It's going to feel like you're never going to get there. But I'm giving you the best way. Like if you're going to learn a language, work around people that speak that language. And because of the exposure to it, when I was working at a restaurant in the Arab family that I worked for, they would speak in Arabic. And then they would say it in English so I would know what they were doing. And I would hear him or them say the words. And then over time, I'm like, oh, yeah, he's saying, are they rung up yet? Did they pay yet? Is this done? How many more left? This is not complete. Or hand them this and hand them that. And it was monotonous for them, but they were nice enough to do that so I could learn Arabic. And that's the equivalent of what I'm doing. I use the real world experience of me learning while working. I'm over top of live price action with you, just like I am with my son. So I'm showing you things as the price is happening, to be delivering higher or lower around specific levels that I think are important, that are pertinent to the ideas that I teach. And I draw your attention to the moments where you're met with a decision. Does it continue, or is it likely to reverse, or is it done for the day? And I share my experience in 30 years of doing this with you real time. There really is no better benefit than having someone that's willing to do this. I would have sawed my left fucking leg off as a 20-year-old when I had all that money lost in drawdown, and just feeling like I wanted to end myself. Literally, I wanted to end myself because I was like, why did I even start doing this? I'm never going to be able to get it. Like it's just, I don't have anybody to lean on. Nobody can help me. Nobody believes in me. My family thinks it's never going to work. My friends are like, I don't get why you keep doing it. So I had no support structure around me. You have such a wonderful opportunity just to sit here and watch. Even if you don't really want to learn what it is I'm doing, I promise you that if you're watching price and you're trading, you're going to see something you didn't see or expect in what you're watching. And it might protect you. It might change your mind about something you may be overhanded in, like you're really, really bearish and you're holding a really big short position. And I'm saying, and watch this level, it's probably going to send us up to that level. When I do that in the live streams, you have my permission to try to protect your ass. Because if you're on the other side of me calling this stuff in the live stream, you're probably going to lose your ass. And I mean that not to be bragging, not to hurt your feelings, not to be arrogant. I mean it wholeheartedly because I'm doing this for my son. I'm not gonna blow smoke up his ass. I'm not trying to deter him from learning the shortest route and directional way to get right to the end of the conversation of knowing what to do. I'm trying to make it complete. I'm also showing him the levels that he has to understand in a graduated manner. And it's up to you to decide whether or not you want to be a part of it. Like I said, I don't care if it's one person that watched it. I know it's my son, and I want to keep doing it. No one's going to stop me. If you don't put thumbs up, I don't give two fucks. I really don't care. You can do a thumbs down. I don't give a fuck. I'm still going to keep doing this. I'm going to do it because he wants to learn, and I want him to learn the correct way. And there's no better way than dad sitting out here doing it with a live chart, recording it, so that way it's recorded, it's logged, it's archived. And even if something bad happens and I lost my laptop, the recordings that are on it don't matter because I have it on an external archive. It's on YouTube. And there's witnesses all around the world seeing me do it, seeing that it works, seeing that the logic is the same stuff. It's not being bent and twisted and contorted. It's there. And now to answer the last question before I go grab something to eat. A Reaper fair value gap. Just because I introduced it, don't think you know it. Don't think because I showed my deuce, you think you know everything. Okay? There are certain little things that change in price that make it one thing or the other. Every fair value gap is not the same. If they share the same space of another PD array, it changes its character. It changes it. It makes it something else. Again, you don't know what the fuck you're talking about. Okay? So stop trying to teach and trying to call it something else. It's not. And when you question me about what I'm annotating on my chart, unless I come back and say, I messed this up, I messed up. And I've done that. Like I've said, I referred to a market maker sell model when it was really a buy model. Or I referred to a second stage distribution when it was clearly going up, and that's reaccumulation, second stage reaccumulation. Because I'm out here without a script. And I'm going to do it eventually in the future. I'm going to say something that slips, that's a slip of the tongue. But that is a Reaper fair value gap that I showed the other day, and I told you to project it through, extend it through, and how many times it used it. Key takeaway, what is August 1st? First day of the week. What time did that gap get referenced? It happens every single month because the algorithm will go back to a specific date. What date would it use? First trading day, first day of week, Wednesday, previous Friday. That's not all of them, but I'm proving that there is an algorithm and it's going back to days specific. Why? Because it has to go back to a frame of reference. We're in a new month. Okay, what month are we in? August. Let's go back to the first day of August. Use the first pertinent PD array of August. Carry it through your chart. And you're going to see shit that you never saw before. That's all I'm going to tell you now. The rest of the stuff will be in the book. But when I give a specific PD array and I annotate it, as long as I don't come back the day after, because I have made mistakes before. I've miscued, miscalled something, and it's just human error. Like I have a Biden moment once in a while. It's just you're gonna have it too. And every live streamer I've ever watched, they've said shit that I don't think they realize that if they go back in that recording, they say, "Oh shit, why did I even say that? It was backwards." It was, but I get it. And if you're a mature audience member, you know what a market maker buy model is if you've been around the block with me. And if it's going up, it's not distribution, that's reaccumulation. So it's just an innocent type thing, but that was an absolute reaper. A reaper is a fucking scythe. It literally cuts through the whole fucking month and makes it so tradable where any opportunity you see where you can engage that one, and as long as it matches time of day when the market should deliver, it's just obvious. This is a real easy. That's one of those times when you ask me, how do you know which fair value you got to use? Well, that's one of them because it has to be anchored to a specific day that is meaningful. First day of month, first day of week. What's the first fair value gap that forms after 9:30 on a Monday? Draw that bitch out through the time over the course of your week and the month. Oh, this is too good. I'll give you too much shit. I'm giving too much away. What the hell? I'm gonna have to open up a mentorship. I'm never gonna be able to eat again. How am I gonna keep giving this shit away for free? How can I make my ends meet if I keep giving it away for free, right? Oh, anyway, I've had so much fun with y'all today. I spent my time way beyond what I wanted to spend. So tomorrow we're going to try to be a little bit more economical and focus just on the 9:30 to 10:30 hour because I want to keep my son's focus into that little time window. Okay, I may leave you with things to annotate and watch going throughout the rest of the day, but Tuesday through Friday, through the rest of this week, we're just going to be doing 1 hour sessions. I don't know which day this week we're going to do 2 sessions in the afternoon. I'm leaving that open because I have to rely on my wife to tell me what that is. We have family members visiting us, and I have to navigate that. So I want to make sure that I tell you in advance. It's not because I got a bruised ego and I did something wrong on the stream and had to close it. I'm telling you in advance that they're going to be shorter because I have to make allowances for my personal family time, but still force my son into studying that individual trading day. Okay. So until I talk to you tomorrow, we'll be back again at 9:15 tomorrow, New York Standard Time, and we'll end it tomorrow around 10:30. And I'll talk with you all then, Lord willing. Until then, be safe.